Yeah, good morning once again. So, a very welcome to you all for the sessions. So, today we'll be discussing, today in our entire session, today the complete session is going to be about the discussion of SA 540. In this session, we are going to understand in a detailed manner the provisions of SA 540, one of the important standard from the examination perspective at the CA final level. So very interesting standard, very conceptual standard. So very easy also, not that complicated. If you don't pay attention, if you don't listen to the session properly, if you don't understand it, if you don't pay proper attention, then it is going to become difficult. But if you pay proper attention, if you follow whatever I'm going to tell you, so then this discussion is going to be damn easy. I will make that standard very easy for you. So one of the most important standard we are going to talk about now, which is SA 540. And one more thing I want to tell you here. See, for this entire standard, I have already developed a summary for entire SA 540, whatever content that we are going to learn. So that entire standard related content, I have even developed a summary also. Even you can use this summary for the purpose of your preparation, for the purpose of your reading of the standard. This summary is going to be very comprehensive, and even you can use it as an alternative for the main material also, that I can say you with confidence. So you can use this particular summary as an alternative from reading the material itself. So in a very comprehensive manner, by making sure that nothing has been left out in this summary, I have taken a lot of caution and prepared this summary. This summary also you can make use of it, and you can prepare for the standard in a much better way. So now let us try to understand what exactly is this standard about. See, as I continuously say, first we need to understand what is the objective of every standard. If we don't know what is the purpose of the standard, if you don't know what is the objective with which the standard has been given, then no matter how many times you try to read it, no matter how many times you try to interpret it, you will not get the correct purpose, correct understanding of the standard. So if we want to get a correct understanding of this any standard on audit, we have to be clear with what is the objective, with what purpose the standard has been given. For every standard there will be a dedicated purpose. So as an auditor, we need to understand what is the purpose of every standard, and accordingly we have to read the standard. Like even earlier standards, whatever we have discussed, like just in the previous class, whatever standard we have discussed, that is SA 570. SA 570 is going to exclusively talk about what will be auditor's responsibilities relating to going concern in the preparation of going concern while conducting the audit of the financial statements. Prior to that, we have seen SA 580. SA 580 is going to talk about what will be the responsibilities of the auditor with regard to written representations while conducting the audit of the financial statements. In the similar manner, this SA 540 standard is also having an objective. And what is the objective of SA 540? So if you read the title of the SA 540, they say auditing accounting estimates, including fair value accounting estimates and related disclosures. So what you are able to make it out from the title, the moment you have read the title, SA 540 is saying something called auditing accounting estimates, including fair value accounting estimates and related disclosures. So by reading this title of the standard, what you are able to make out? What do you think this standard is going to talk about? So from the title, one thing should have been very much clear. This standard is going to talk about something relating to accounting estimates. So this particular standard SA 540 is going to talk about how to conduct audit of the accounting estimates. That is going to be the main concern of this standard. So but before we can understand what is auditor's responsibility regarding accounting estimates and all, first we need to understand what exactly is an accounting estimate. First we need to understand what exactly is an accounting estimate. So let us first try to understand what is the exact meaning of the term accounting estimate. Once we become clear, okay, this is what exactly the term accounting estimate is, then we will think of what will be the auditor's responsibilities. Okay, so first we will make ourselves very clear what is the meaning of the term accounting estimate. So guys, we all know who is responsible for preparation of the financial statements. Who is responsible for the preparation of the financial statements? Management is always responsible for the preparation of the financial statements. Take for example, you are conducting audit of some entity, Reliance Industries Limited. So if I am conducting audit of entity Reliance Industries Limited, my objective as an auditor, my objective is to verify the financial statements, verify the books of accounts, try to express an opinion whether this financial statements and books of accounts, which we collectively call it as financial information, whether it is giving true and fair view or not. Expressing an opinion on the financial statements is my responsibility. Whose responsibility? Auditor's responsibility. Whereas, will you prepare the financial statements? No. Will you prepare the books of accounts? No. The responsibility for the preparation of the financial statements and the preparation of the books of accounts, that always and always rest with the management. The management of the organization is always responsible for the preparation of the financial statements and maintenance of the books of accounts. That is, collectively we call this information as financial information. So the preparation and maintenance of the financial information is always going to be the responsibility of management. And the management, while preparing the financial statements, take for example, while preparing the balance sheet, while preparing the statement of P&L, they will prepare actually this financial statements and books of accounts from, they will actually prepare this balance sheet and P&L from the books of accounts. Now, in the process of preparation of the books of accounts and P&L and balance sheet, the management cannot get to know about each and every item with accuracy in the preparation of the financial statements and books of accounts, or whatever items are there in the financial statements, whatever items are there in the balance sheet and P&L, the management cannot accurately measure each and every item in the financial statements. There will be certain items in the financial statements which we can't measure with accuracy, and since management is unable to measure those items with accuracy, they will estimate the figures. What they will do? They will estimate the figures. So the management, while preparing the financial statements, because the nature of those items is itself that all the items in the financial statements, the management cannot exactly measure them. The management cannot exactly calculate them. There will be so many items in the financial statements. There will be various items in the balance sheet. There will be various items in the P&L where management cannot measure it accurately. They can't do precise calculation. What they can't do? They can't do the precise calculation of that figures. Since they are unable to make the precise calculation of the figures, what they will do is they will estimate that figures on the basis of various assumptions. They will estimate the figures on the basis of various assumptions. So those items, those assumptions, those estimates which are made by the management where they are unable to do the precise calculation, that we are going to simply call them as accounting estimates. Those items in which management is going to determine the figures not on the basis of the precise calculation but on the basis of estimates, assumptions, those items of the financial statements, we are going to call them as accounting estimates. Guys, can you give me a few examples in which areas management will do a assumption, management will do a estimate instead of doing the precise calculation? See, why the management is going for estimate is not because of their choice. They don't have any other alternative. Why management will do estimate, why management will not do a precise calculation is it is not possible. Only in some items the management cannot make the precise calculation. Only it is not possible to make precise calculation. That's why only they are using estimates. So can you give me a few examples, the examples of those items where the management cannot do precise calculation, where they will be determining the figures purely on the basis of estimation? Can you give me a few examples? Like when we talk about the balance sheet items, there will be depreciation. We show fixed assets. From the fixed assets, we reduce depreciation. No, this depreciation is an accounting estimate. Calculation of depreciation is an estimate, accounting estimate. Sir, why depreciation is an accounting estimate? Why? Because depreciation is an estimated figure. It is not a precise calculation. For example, if you want to calculate the depreciation, what is the formula for calculating depreciation? Cost minus residual value divided by useful life. So in this entire formula, the management will know only cost with accuracy. Whatever cost they have spent, that is the only item which the management will know with accuracy. That is the only item which management can do precise calculation. Residual value, what will be the residual value after the useful life? Once you have used the asset for 5 years or 10 years, after 5 or 10 years, what will be the value of that asset? Can you exactly calculate it? No. But what management will do? They will make an estimate. Residual value is an estimate. Useful life. Today I am buying a plant and machinery. So I have to determine today itself for how many years I will be able to use this particular plant and machinery for. Today itself, I don't know exactly how many years. See, for example, if I buy the machinery today, exactly when it will stop working, I can't do the precise calculation. So management, what they will do is they will estimate depending upon the nature of that asset, depending upon the nature of the industry, depending upon the manner of the usage. The management will estimate, okay, depending on keeping all these factors in mind, this plant and machinery can be expected to be used for a duration of 5 years. So if you take this entire formula of the depreciation, so in this three components are there. Out of that three components, cost is the only thing which management can do the precise calculation. Realizable value is an estimated figure. Useful life is also an estimation. So ultimately, the calculation of depreciation is going to be an estimated figure. It is an example of the accounting estimates. Not just that, provision for expenses also is an estimated figure. There are various provisions for expenses which management will make, which they don't know with accuracy, and they will make use of estimate. Take for example electricity expenses. You are doing audit, for example. Your management is preparing the financial statements for the financial year 22-23. Now they will come to know what is the electricity expenses from the month of April till the month of February. They will get the bills from the electricity department. They will get to know what is their exact electricity expenses for these 11 months. But for the month of March, they are going to get the electricity bill after March. After 31st of March, they are going to get the electricity bill. But for the month of March, they have to create a provision. For the month of March, they have to create a provision. How they will create the provision, sir? They don't know what will be the exact figure for the expense, what will be the exact figure of electricity expenses now. It will get known only when you get the electricity bill. But still, as on the balance sheet date, management has to create a provision for that electricity expenses for the month of March. So how they will do it? They can't precisely calculate. What they will do? They will make an estimate. So provision for expenses is an estimate, is an example of accounting estimate. Provision for tax, calculation of tax provision, especially deferred tax asset, deferred tax liabilities. That calculation of the provisions for provision for taxation, provision for deferred taxes, everything is an accounting estimate. There also management has to make use of assumptions and estimates. Yes or no? Not just that, provision for bad and doubtful debts. From the debtors, we reduce the balance of provision for bad and doubtful debts. Provision for bad and doubtful debts is also an example of accounting estimate. Management cannot know how much exact amount will not be paid by the debtor. We don't know. We make an estimate. For example, there is a debtor from whom 1 crore rupees of amount is pending. We don't know what exactly he will be able to pay. His financial position is becoming bad day by day. Everybody in the market is saying that this person will go bankrupt and his assets will be attached. So everybody is talking about this debtor. We don't know in the future what will be his financial position. So we make a rough estimate. Management will make an estimate. Okay, this debtor is about to go bankrupt. We might recover only out of 1 rupee, we might recover only 60 paise. That means out of every 1 rupee, 40 paise will not be able to realize. That means 40% we might not be able to realize. We might not be. I'm not telling we will not be able to realize. Management will make an estimate. We might not be able to receive 40% of our money. The management will create provision for bad and doubtful debts for 40%. They will create a provision for 40 lakhs. This is also an accounting estimate. And even in the valuation of inventory, while you are valuing an inventory, in inventory, how do we determine the value of the inventory? The AS2 says inventory should be valued at cost or NRV, whichever is lower. How we have to value the inventory? Inventory should be valued at cost or NRV, whichever is lower. Cost is something which we can know with accuracy, but NRV is once again an accounting estimate. NRV is also once again an accounting estimate. Sir, how come NRV is an accounting estimate? What is the meaning of NRV, guys? The net realizable value means the amount which you will be able to fetch if you sell the asset, if you sell that particular item in the market today. So generally they say NRV formula is estimated selling price minus estimated cost to make the sale. Yes or no? So this is how, if you determine the estimated selling price, from that if you reduce what is the expected cost of making the sale, the balance value whatever you get, that is an NRV. If you pay close attention, here we are going to estimate the selling price. For example, if the company is dealing in goods, so as on the balance sheet date they have 10,000 quantity of stock as on their balance sheet date. Now they have to determine what is the value. So this 10,000 for this 10,000 quantity of stock, take for example cost for each item is 100. But I have to determine NRV. NRV means what? If I have to sell the goods today, how much value I will be able to realize? In order to determine NRV, do you think management will go and sell all their stock in the market and then determine NRV? No. What they will do? They will study the market terms and conditions. They will study what is the demand for the product today, what is the supply for the market today, what is the competitor doing. So keeping all these factors in mind, they will estimate, okay, if I sell my inventory in the market today, I will be able to fetch only 99 rupees. Estimated selling price. They are not actually going and selling and determining it. Depending upon the current market condition, they are only estimating this much amount I will be able to realize. 99 rupees only per unit I will be able to realize. And in order to make that sale, I have to incur a cost of 1 rupee. I might be required to incur a cost of 1 rupee. So net I am going to get 98 rupees if I go and sell my stock in the market today. So this 98 is an NRV, which is purely an estimated figure. It is purely an estimated figure. So this NRV is also an accounting estimate. Not just this, guys, there are so many items. There will be plenty of items in the financial statements, in the P&L, in the balance sheet. There will be plenty of items where we are going to make, where the management will make estimates, where they will not be able to do the precise calculation. Here the example is very few examples I have given. There are plenty of other examples. So examples which I have given to you is a depreciation, I have told, provision for bad and doubtful debts, inventory, NRV calculation, provision for taxation, provision for expenses. There will be something called warranty obligations. If the company is especially dealing in the electronics, they will sell the goods under warranty. For the warranty, they have to create a provision well in advance. So warranty provisions, that is also an accounting estimate. If the company is going through litigations and claims, if the company is going through any litigation, if the company is going through any case, what is the outcome of that case? Will the company win the case? Will the company lose the case? In case if the company is having a chances of losing the case are much higher, create a provision. In case if the chance of company winning the case is much higher, still show it as a contingent liability. Here also, whether the company will win the case, will lose the case, once again a matter of estimation. So in the area of litigations, there will be so many estimates which will be used. Investments, companies will make their investments. If they have any excess funds, they will go and invest their money in the equity market, in the share market. They will go and invest in the mutual funds. They will invest in the debentures. They will invest, and in also various other kind of in derivative contracts like futures, call options, put option, futures. In these kind of instruments also they will hold the investments. And as per the Ind AS, some investments are required to be stated at fair value. Some investments are required to be stated at what value? Fair value. Fair value means what? If I go and sell the investment in the market today, if I have, for example, 10,000 units of the mutual fund, if I today go and sell that, mutual funds in the market today, how much value I will be able to realize? Fair value we call it. So even this investments, in some cases, as per the Ind AS, some investments are required to be stated at fair value, some investments are required to be valued at the fair value. And how you will determine the fair value? On the basis of estimated market position today. So like this, there are plenty of items in which the management cannot determine with precise calculation, determine with accuracy, and in those cases they will not have any other choice except making an accounting estimate. So these are various examples. Let me show you one example of accounting estimate which management might have done in some companies. So take for example, here we have Infosys related financial statements we have. So if we go through Infosys related financial statements, in the notes to accounts, they will give a disclosure. Every company generally will give in their notes to accounts a disclosure in what areas they are making use of accounting estimates. So they will just give a brief. Similarly, in the Infosys annual report also, let us see what the management is telling in which areas they have made use of the accounting estimate. So let us have a quick look at it. So this is actually Infosys financial statements, right? If you see here, so these are the notes to accounts. As we all know, in the notes to accounts, management will give explanation about what accounting policies they have followed, they will also give breakup of the items which are there on the face of the balance sheet and P&L. All the disclosures will be given. Yes. So if you see here the notes to accounts has started. This is where the notes to accounts has started. So in the notes to account, if you see here, use of estimates and judgments. See here in the notes to accounts, management is trying to say, Infosys management. I'm reading financial statements. Financial statements are prepared by the management. We are talking from the management perspective. I did not talk from the auditor's perspective. Till now, whatever discussion I have had, I'm talking everything from the management perspective. So use of estimates and judgments. Let us see what they are telling. The preparation of the standalone financial statements in conformity with Ind AS requires the management to make estimates, judgments and assumptions. In order to prepare the financial statements as per Ind AS, the management is required to make various estimates, assumptions and judgments. These estimates, judgments and assumptions affect the application of accounting policies and reported amounts and assets and liabilities and disclosure of contingent assets and liabilities on the standalone financial statements. That means whatever estimates they have made, whatever assumptions they have made, whatever judgments they are made, they are going to affect various items of the financial statements. They are going to affect incomes, they are going to affect expenses, they are going to affect assets, they are going to affect liabilities, even they are going to affect the disclosures and the notes to accounts also. And the application of accounting policies that require accounting estimates which involve complex and subjective decisions, blah blah blah. So all these things they will say, this is not important from our examination perspective. Just I wanted to show you the practically some things. Like if you see here, if you see this note number 1.4, they are telling some of the critical accounting estimates whatever they have made. Infosys company, while preparing the financial statements of their organization, what are some critical accounting estimates they have made? In which areas they have made some important accounting estimates? First they are telling revenue recognition. So they are telling in the area of revenue recognition, they have made use of the accounting estimates. Sir, how come in the revenue recognition accounting estimates will be there? If you remember, when we discussed SA 701, when we understood the key audit matter, I have explained you how the revenue recognition will happen in the IT company. So as I've told, generally IT companies will enter into long-term contracts. Take for example, this Infosys company has entered into 5-year contract for the execution of IT services for one entity. Now for this 5 years, for the total 5 years of project, they have got a contract for 10,000 crores. How this revenue will be recognized? Will it be recognized all at once? No. This 10,000 crores of revenue has to be recognized over its project life. Over the period of 5 years, they have to recognize. Sir, how they will recognize? Can they recognize simply on SLM basis? Every time it will not work. SLM will work only when IT company is expected to provide equal quantity of services each and every year. But that is not how practically IT services will be executed. So in that cases where every year you are not executing same amount of work, in those cases we use some method called percentage of completion. The auditor will recognize revenue on the basis of percentage of completion. Nothing but in every year, like for example, year 1, year 2, year 3, year 4, year 5. Every year he has to determine percentage of completion. That much percentage he will recognize as revenue. Sir, but how to calculate percentage of completion? So how the percentage of completion will be calculated is, first the management has to estimate total efforts required for completion of the project for this entire 5 years. That means over the period of 5 years, in order to complete this project, how many total man hours will be required? So that you will not know it now. If I have entered a contract for 5 years now, today itself I can't say how many hours I want for completing this entire project. So but what management will do, they will make an estimate. So they will estimate whatever efforts are there. They will estimate the efforts for the entire 5 years of time, and they will determine what are actual efforts executed in the current year for this project. This they will exactly calculate. Actual hours that have been spent in this project, that you can calculate. But the denominator, how many total hours or how many total hours are required for completing the entire project, that is once again an estimate. Take for example, if for completing this project, estimated efforts are 10,000 hours, but in the year 1 they have already executed 2,000 hours on this project. That means 20% of work has been completed in the year 1. 20% of the revenue will be recognized. So if you see this entire formula, the revenue recognition depends on percentage of completion. Percentage of completion depends on this formula, and this formula, one of the important factors to determine how many total efforts will be required for completion of the entire project, which is purely an estimated figure, which is not an exactly precisely calculated figure. So that's why one of the major area in IT companies where they will make use of accounting estimate is revenue recognition. When you open the statement of P&L, the first and foremost item, whatever you see, revenue, that itself is an accounting estimate. When you open the P&L of an IT company, so generally when we open the P&L of an IT company, first item what we will find in the P&L? We'll find in the P&L the first and foremost item, revenue. Yes or no? See here, revenue from operations. The moment you open the statement of P&L, you are able to find something called revenue from operations. And let me tell you, this revenue from operations itself is an estimated figure, not an exact figure. This revenue recognition is itself is an what? Estimated figure, not an exact figure. So the management itself is telling, I am not telling it, the management itself is telling, one of the major area where we are making use of accounting estimate is revenue recognition. So that revenue recognition itself, one of the major item of the financial statement, that itself is not a precisely calculated figure, that itself is an accounting estimate. Not just that, they say even other areas also, like income taxes. They are telling even in the income taxes also they make use of estimates, especially for deferred tax assets and deferred tax liabilities. For calculation of these deferred tax assets and liabilities, they make use of assumptions and estimates. So they have told the other area in which they will make use of accounting estimates is income taxes. Then property, plant and equipment. Sir, how come they will use how they will use accounting estimates in the area of plant and machinery? As I have told you, depreciation. for the purpose of calculation of depreciation. Depreciation, as I've told in the formula, we need 3 components. Out of the 3 components, only 1 component we know it with accuracy. The remaining 2 components we don't know it with accuracy. We estimate, like what is the useful life, what is residual value. So they told one more important area where they will make use of accounting estimate is depreciation. These are not only areas. If you see here, the management is explaining only critical accounting estimates. What are the most important areas they have made accounting estimates? These two are not the only areas where the management has made accounting estimates. There will be plenty of areas. If you start scanning the items of the financial statements, you might find plenty of areas where they might have made use of accounting estimates. Clear, everybody? So this is what the meaning and understanding of the accounting estimate. So till now, I did not explain anything regarding audit. Till now, I did not explain anything regarding audit. I was continuously explaining you about what is the meaning of accounting estimate from the accounting standards perspective. What is the importance of accounting estimate in the preparation of the financial statements? That only I am explaining. Okay. Now you all will get it out. Sir, there are so many items in the financial statements. There are so many different approaches we follow for different items of the financial statements. Why we are paying specific attention only for accounting estimates? What is the importance of the accounting estimates? Why we need to focus more? There are so many items in the financial statements. There are some items in the financial statements which are not measured on the estimated basis, which are calculated on the precise calculations also. So there will be some items which will be calculated precisely. There will be some items which will be estimated. But why a lot of focus on accounting estimates? Why so much of attention for accounting estimates? Why are you asking us to concentrate more on accounting estimates? Why a specific standard has been given for guiding us to obtain audit evidence regarding accounting estimates? Sir, why that much importance is required? Why you are driving our attention to the accounting estimates? Why? Because accounting estimates is a risky area. Accounting estimate is an risky area. Sir, why accounting estimate is a risky area? The nature itself is like that. See, when you know something, when you can calculate exactly something, when you can precisely calculate certain amount, you can verify it easily. But when something has to be estimated, when I say estimate, I have to estimate. Estimate is purely my opinion. I will make an estimate purely on my opinion. So basically, whenever estimates are getting used, we are using estimates because we don't have precise calculation. We can't precisely calculate the amount. That's why we are using accounting estimates. So whenever you are using estimate, whenever you are estimating and figure, when you are not exactly calculating and figure, but you are estimating and figure, you are assuming and figure, you are deciding, your opinion is letting you decide what amounts has to be stated in the items of the financial statements. That itself is a risk. Since we can't measure that with accuracy, it all depends on estimates. That is going to be very, very risky area. There is a high chance of happening of misstatements in the area of the accounting estimates. So that's why the standards on auditing has requested the auditor to focus more on accounting estimates, and they have given a specific standard which will guide us in how to obtain audit evidence regarding accounting estimates. Why? Because they carry a higher risk of material misstatement. So nothing but why that risk will arise because of the accounting estimates. Why? Because here I am going to introduce to you one more term. Accounting estimates require specific attention because they have something called estimation uncertainty. Estimation uncertainty. So why accounting estimates require more attention? Why accounting estimates require a lot of focus? Why we need to pay specific attention for accounting estimates is because there will be something called estimation uncertainty. Sir, what is the meaning of estimation uncertainty? Nothing but, see, by the end of the day, when I say accounting estimate, I am only assuming. Like for example, provision for doubtful debts, provision for bad and doubtful debts I have calculated. There is a debtor who is required to pay to the company 1 crore rupees, but his financial position is very bad. So management thought, let me create a provision for this debtor. So management consider various factors. First of all, how the management will determine the assumptions, how the management will determine the accounting estimates. What they will do is they will study the past data. They will study past data. They will go through contracts and all. They will go through contracts, agreements and all. They will have a look at, they will make assumptions. They will look at current market conditions. So like this, management will consider various factors and accordingly they will decide the provision. Take this case only, debtor has gone bankrupt. So debtor is ready to go, about to go bankrupt. He's not making us a payment from a very long period of time. Management thought, okay, this 1 crore rupees will not be completely recoverable. We have to create a provision. But how much a provision has to be created? How the management will decide? Management management will go to the past, analyze the past transactions. So check the financial position, check the market position of this particular debtor. So like this, they will consider various factors, and management has decided that okay, out of this 1 crore rupees of amount, 40% will not be recoverable, estimating, not precise calculation, estimation. So this amount is not recoverable, so they have created a provision for 40 lakh rupees. So they have determined an accounting estimate for 40 lakh rupees. But this is purely on what? Estimate. Now, this estimation can be correct also. This estimation can go wrong also. This estimation can be correct also. This estimation can be going wrong also. See, when I say estimation is always having a chance of going wrong. So whatever provision management has created, management thought that out of this debtor, 40% will not be recoverable. That's why they have created provision for 40 lakhs. In the future, actually, the debtor might not pay this 40 lakh rupees exactly, or he might not pay some excess amount. He might pay some more amount. We can't say it. For example, I have created a provision for 40 lakhs. Next year, what happened is, when this debtor has actually gone bankrupt, when his assets were transferred to the official liquidator, the management was able to realize only 50 lakh rupees. That means they created a provision for 40, but in fact, the actual loss was 50 lakh rupees. Nothing but whatever estimation you have done, that has gone wrong. Yes or no? In some cases, what might have happened is, you thought, for example, out of 1 crore, after taking 40 lakh rupees, you thought that 60 lakhs will be recoverable. But in the future, when the assets were transferred to the official liquidator, you are a lucky fellow, you received 70 lakh rupees. You received 10 lakhs more than whatever you have thought of. Here also, estimation can go wrong. So whenever we are making an estimation, it is an inherent nature of that inherent nature of that estimation, that whatever estimation we have made, that could even go wrong as well. So that possibility of accounting estimate going wrong, that in simple terms, if I put it, that we call it as estimation uncertainty. That we simply call it as what? Estimation uncertainty. Clear, everybody? So accounting estimates, since they carry an estimation uncertainty, they carry a risk of material misstatement. Here the chances for manipulations are higher. Here the chances for misstatements are higher. So that's why as an auditor, you need to pay more attention for this accounting estimates. Clear, everyone? So what I have told you till now, let us make a summary. So I told what is the meaning of accounting estimate. We have seen examples of accounting estimate. We have seen who will make the accounting estimate. Management will make estimate. And while making the estimate, what the management will do, they will consider various factors. They will consider their past experience, and if they have to create a provision for warranty. See, warranty provisions are also estimate. For determining what could be the warranty provision, they can go through that warranty contracts. Yes or no? So they will assess the current market position. Like for example, if you have to determine NRV, they will determine NRV on the basis of current market conditions, like current demand and supply. So like that, management is going to make use of various factors. They will consider various factors. Then accordingly, they will determine accounting estimate. Okay. So now let us talk about fair value accounting estimates. If you see the title of the standard, auditing accounting estimates including fair value accounting estimates. Sir, what is this fair value accounting estimate? So let me try to explain this also. See, accounting estimates, I can divide them into two categories. Those accounting estimates which involve fair value measurements, or other accounting estimates. Accounting estimates, we can broadly divide them into two categories. Those accounting estimates which will be determined on the basis of fair value, which includes usage of the fair values. Whereas other accounting estimates which does not involve usage of the fair value. Sir, what is fair value? Fair value means nothing but as on particular day. If the transaction is taking place between two unrelated parties, what will be the price at which that transaction is going to happen? Like for example, if a item is there, for certain goods are there, if it is required to be sold in the market today, so buyer and seller both are unrelated parties. If an unrelated seller sells that goods under normal market terms and conditions to the seller, how much value he will be able to fetch? So that is exactly what fair value. See, there will be some accounting estimates which involve usage of this fair value, whereas some other accounting estimates will be there which does not involve usage of this current market values and all. So if I give you examples of accounting estimates which doesn't require any fair value adjustments, like for example, provision for bad and doubtful debts, provision for expenses, provision for taxes. So these are all something which will be determined on the basis of our past experience. If you take these kind of examples of provisions, like provision for bad and doubtful debts, provision for expenses, provision for taxes, and these kind of provisions basically doesn't involve any usage of any usage of the fair values. They will be determined purely on the basis of our past experience. But if you take some other accounting estimates, like for example, investments, Investments are required to be determined at fair value. Like for example, if the company is holding some mutual funds, as on the balance sheet date, they have to determine what is the value of this mutual funds. In order to determine what is the value of this mutual funds, they have to go and see what is the current market price of this mutual funds. That is what the meaning of fair value. So investments, valuation of investments is something which we have to determine using fair value. And also NRV for assets, NRV for property, plant and equipment. Sorry, NRV for inventory. Inventory has to be valued at cost or NRV, whichever is lower. How to determine NRV? NRV has to be determined on the basis of current market prices. So accounting estimates are divided into two categories. Those accounting estimates which involve fair value adjustments, whereas other accounting estimates which will be purely determined on the basis of past data and all. So you tell me where estimation certainty you think will be higher. In which accounting estimates estimation certainty will be much higher. That means the chances of accounting estimates going wrong, where it will be much higher. So practically speaking, wherever fair value accounting estimates are happening, there the chances of estimation, there the risk of estimation uncertainty is much higher. There the chances of accounting estimate going wrong is much higher. Yes or no? Like for example, if we take provision for bad and doubtful debts, more or less on the basis of our past experience, we can calculate it with close to the actual outcome. Next one, if you take provision for tax, since we are basing our tax provision on the basis of income tax laws and regulations, the chances of that provision going wrong also very less. I'm not telling it will be exactly correct, but the chances of it going wrong are there, but little. And also provision for other expenses, since you have a past track record of your expenses, so whatever provision you are going to calculate for expenses, that will be more or less less estimation uncertainty will be there. But whenever you are determining some accounting estimates on the basis of the fair value, the fair value itself is little bit uncertain. So what is the market value as on today? So that itself is going to be little bit uncertain. So in respect of accounting estimates which involve the fair value adjustments, there the estimation uncertainty is higher. There the chance of that accounting estimate going wrong is much higher. So I have explained two kinds of accounting estimates which involve fair values, accounting estimates which does not involve fair value. In which case estimation certainty is higher. Generally those accounting estimates in which fair value are getting used, that the estimation uncertainty is going to be little bit higher. Clear everybody till here? Right. See, we need to know one more term. Take for example, accounting estimate has been created. Accounting estimation has been created. Take for example, provision for expenses. The management is creating some provision for expense. As per the accounting estimate, as per the various factors considered by the management, they created provision for expenses as 1 crore rupees. Provision for expenses as 1 crore rupees. See, this is just a word provision, estimation. After certain period of time, this expense, what is the exact expense, we will come to know it, right? Management has created provision purely out of estimate, but in the future at certain point of time we will come to know what exact expenditure it is. Till the time we don't have that certainty, we create a provision. So you created a provision for 1 crore. At a future point of time, what is that exact amount of expense you came to know? In the future you came to know that the actual expense for which you have created a provision for 1 crore is, the actual expense turned out to be 90 lakh rupees only. The actual expense turned out to be 90 lakh rupees only. This we call it as outcome of that accounting estimate. This is the estimate you have done, but when that estimate has turned into reality, the actual outcome is 90 lakh rupees only. So you created a provision for 1 crore, but when actual expense you came to know about the actual expense turned out to be 90 lakh rupees. There is a difference between the accounting estimate and its actual outcome. Can we call that difference as a misstatement? Can we call that difference as a misstatement? No, we can't call that difference as a misstatement. Sir, why you can't call that as a misstatement? Why? Because that itself is an estimate. We are making an estimate because we can't calculate it with accuracy. That's why we have made use of an estimate. That estimate will always carry uncertainty. No, whatever estimation I have done, that can always go wrong. So that is not a misstatement. That is the inherent nature of the accounting estimate. If your accounting estimate and what is the actual outcome of that accounting estimate, if both are not matching, that you should not consider it as a misstatement. There will always be estimation uncertainty at the time of creating the accounting estimate. Only we have to recognize that there is always a possibility of that estimation going wrong. We can't avoid it. Okay, so when the management has created an accounting estimate, but it is different from the actual outcome of that accounting estimate, we should not treat that as a misstatement. That is the nature of that financial statements. That is the nature of the accounting. We can't avoid it. Clear, everybody? Right. So this is one more thing which I want to bring it to your attention. So once again, if you pay close attention, till now I did not talk about audit. Even till now also, we did not talk about audit. Just I'm talking from the management perspective. So I have explained what is the meaning of accounting estimate, what is estimation uncertainty, and how many kinds of accounting estimates will be there. Accounting estimates involving fair value, not involving fair value, and what will be the actual outcome. If there is a difference between estimate created and the actual outcome, we don't call it as a misstatement. And what factors management will consider in determining accounting estimate. So what and all relating to the management responsibilities, that's what we have seen till now. But as we all know, standards on audit doesn't talk about management responsibilities. The standards on audit are going to talk about auditors' responsibilities. The standards on audit is going to talk about auditors' responsibilities. Sir, what will be auditor's responsibility? So auditor's responsibility is very, very simple. First, you need to understand. First, you will perform risk assessment procedures. You will try to understand about entity. You will try to understand about environment. You will try to understand about internal controls. Risk assessment procedures we do in every audit. At the beginning of the audit, we will try to obtain an understanding of entity, environment, and its internal control. See, whenever you are performing risk assessment procedures, whenever you are trying to understand entity, environment, and its internal control, you should also try to understand what are the areas of the client where accounting estimation will be required. As a part of your risk assessment procedures, when you are trying to obtain an understanding of entity and its environment and its internal control, when you're actually trying to identify the risk of material misstatement, you should also identify those areas in the client's financial statements which require accounting estimates. You have to make a list of all that areas which require accounting estimates. Yes or no? And you should find out risk of material misstatement. So there will be multiple areas in which accounting estimates will be there. You need to determine which accounting estimates have high risk of material misstatements, which accounting estimates will have low risk of material misstatement. Which accounting estimates will have high risk of material misstatement, which accounting estimates will have low risk of material misstatement, that you have to determine. At the same time, you should also try to understand what are the requirements of the applicable financial reporting framework. You should also try to understand what are the requirements of applicable financial reporting framework regarding accounting estimates. What does the Ind AS say? What does the Schedule 3 say? So what are the accounting requirements? What are the accounting and disclosure requirements regarding accounting estimates as per the applicable financial reporting framework, that we have to understand first. So that's what we do in the risk assessment procedures. We try to identify in which areas accounting estimates are required, in which areas of accounting estimates risk is higher, in which areas of accounting estimates risk is lower, and what are the requirements of the applicable financial reporting framework. This we will find out. So once you have found out the risk, once the risk of material misstatement is found out, then what we do? Then we perform further audit procedures. We respond to that risk. Nothing but we try to perform further audit procedures. Sir, here what I will do? I will try to ask the management. I will try to inquire the management how they have calculated that accounting estimates. How they have calculated accounting estimates. I will ask the management to share with me what and all workings they have done. I will ask the management to share with me all the workings, whatever they have done for the purpose of calculation of the accounting estimates. I will sit with them. I will discuss with them. I will try to understand what assumptions they have made. I will sit with them. I will discuss with them what assumptions they have made, and whatever underlying contracts are there, that I will read. For example, if warranty provision is getting created, I will try to read that warranty contracts. If the provision is getting created for employee benefit expenses, like provision for gratuity, provision for leave encashment, provision for bonuses, so there I will read that contracts with the employees. There I will read the contracts with employees. In some cases, I might need to take the help of an expert. For example, if some litigation related estimation management is doing, I don't have complete evidence. I'm unable to obtain audit evidence completely regarding this pending cases and all legal cases. I don't have that much knowledge. What I can do, I can go and take the help of expert like lawyer. Or sometimes for the purpose of calculation of estimates, management will take the help of actuary. So even I might take the help of this person called actuary also. Like this, if required, I will try to even take the help of experts as well, like lawyers, actuaries. These people help also I will take for determining whether accounting estimates are correct or not. So all these things I'm going to do. I am going to do inquiry. I will study the accounting standards. I will try to understand. I will try to get the workings. I will try to read the contracts. I will try to inspect various documents. If required, even I will take the help of expert as well. And then finally, I will determine whether accounting estimates are reasonable or not. And finally, I will try to determine whether accounting estimates are reasonable. Very, very important term. See, the standard will not ask us to determine whether accounting estimates are correct. Very important term I am saying here. The standard on audit, the SA 540, did not ask the auditor to determine whether accounting estimates are correct. In fact, we can't do it. We cannot determine whether accounting estimate is correct or not. Why? Because estimation is an estimation. It is something which cannot be precisely calculated. How you can say estimation is correct? You will not be able to say estimation is correct or not unless that actual reality comes into picture, which will come in the future. So that's why the standard did not expect you to determine whether accounting estimate is correct. No, the standard is not expecting. For example, if the management has taken a useful life of 5 years for the asset, the standard is not expecting you to determine whether 5 years of useful life is correct. That is not auditor's responsibility. You can't even determine whether exactly this asset will work for 5 years or not. How can I tell it correctly? I can't say it. So, but what the standard is expecting from you is you have to determine whether accounting estimate, whether this useful life of 5 years is reasonable, is it acceptable? As an auditor, you have to use your professional judgment. You have to perform audit procedures. You have to obtain audit evidence, keeping in mind the nature of that plant and machinery, keeping in mind the usage, keeping in mind the number of the frequency with which it is getting used, keeping in mind the maintenance activity which the organization is taking forward, keeping in mind the nature of the industry to which this client belongs. I have to determine, okay, is it acceptable? Is a 5 years of useful life for this plant and machinery is acceptable? So that only you need to obtain audit evidence. Very, very important term I have told you here. The standard SA 540 did not expect the auditor to obtain audit evidence whether accounting estimates is correct. No, the standard is not expecting from you. The standard is only expecting for the auditor to determine whether accounting estimates are reasonable. Are they acceptable? Are they reasonable? That only you need to obtain audit evidence. The standard cannot expect from you to determine whether accounting estimates are correct or not. So this is what the responsibilities of auditor. First, he will perform risk assessment procedure, identify the risk of material misstatement relating to accounting estimates. Then in order to address that risk, whatever he has identified, he will perform further audit procedures. So all this further audit procedures he will perform. And finally, he will try to obtain audit evidence whether accounting estimates are acceptable, not acceptable. If everything is okay, he will give unmodified opinion. If he finds that some accounting estimates are not acceptable, so management has created wrong accounting estimates, they are using judgments in a wrong way to manipulate the financial position, then he will give a modified opinion, and this reporting requirements he will take out through the audit report. With that, the auditor's responsibility will come to an end. With that, auditor's responsibility will actually come to an end. That's all. This is what the entire standard is about. So first we have understood, I have explained the entire concept of this SA 540. Now only reading part from the material is pending. Let us try to read from the material and complete this standard. Okay, shall we do it? Hope you guys are all able to understand the content, the practical concept regarding SA 540. What is accounting estimate? What are management responsibilities? What are auditors' responsibilities? I hope you are all able to understand. I want a quick confirmation from each and every one of you. Are you able to understand the conceptual discussion in a practical way? I have tried to bring in a lot of practicality in the discussion. Hope you guys have all understood it. So just give me one quick response so that we can proceed further. Everybody, I need a quick response from you all before I take it up further. Come on, guys, make it fast. Perfect, guys. Thank you so much. Thanks for your reply. I hope you guys are all enjoying this discussion. It's not something I'm just teaching you from the books. I'm bringing a lot of practicality in here. I hope you guys are enjoying this discussion and you are able to have that practical exposure in the class. That's what my main intention is. So now let us have a look at the material. Right. So let us start discussing. So what are the objectives of auditor? What are the objectives of auditor? Why this standard has been given? As per this standard, what are your responsibilities? Let us see what are the responsibilities of the auditor. The objective of the auditor is to obtain sufficient appropriate evidence, whether in the context of applicable financial reporting framework, accounting estimates, including fair value accounting estimates in the financial statements, whether recognized or disclosed, are reasonable. So whatever accounting estimates are there, including fair value accounting estimates, whether they are recognized or they are disclosed. Like for example, if you take contingent liability is an accounting estimate which is only disclosed. If you take provision is an accounting estimate which is recognized. So whatever it is, some accounting estimates will be recognized in the books. Recognized in the sense they will be stated in the statement of P&L and balance sheet. Some will be disclosed. Disclosed means what? They will not be shown in the balance sheet and P&L. They will be shown in the notes to accounts. Whatever it is. Example of accounting estimate which require disclosure is a contingent liability. Example of accounting estimate which require recognition is a provision. So depending on whether it is recognized, accounting estimate whether it is recognized, accounting estimate whether it is disclosed, that should be reasonable. First, as an auditor, I should obtain sufficient and appropriate audit evidence that whatever accounting estimates are there which require either recognition or which require disclosure, whether they are reasonable, whether they are acceptable or not. And also related disclosures in the financial statements are adequate, and whatever disclosures, whatever explanation the management has given regarding the accounting estimates in the financial statements, are they reasonable, are they acceptable? Clear? So that is the first objective. Now let us talk about a few definitions. First thing, accounting estimate. What is the meaning of accounting estimate? So what they are telling, an approximation of a monetary amount. a approximate monetary figure in the absence of precise means of measurement, where we can't measure something with accuracy, where we can't precisely measure. Precise measurements mean what? Exact calculation. So where we can't do the precise calculation, where we can't exactly calculate the figures, there we make an approximation of some value. So that approximated figure, we call it as accounting estimate. This term is used for amount measured at fair value, where there is estimation uncertainty, as well as other amounts that require estimation. As I've told, accounting estimates involve two kinds: accounting estimates which involve fair values, accounting estimates which does not involve the fair value. Examples also we have seen. So let us see that breakup. Accounting, if you see here, if you come here, examples of situations where fair value accounting estimates may be required. So they have given a few examples of the accounting estimates where we have to estimate that figures using fair value, bringing in the fair value concept. So what are the examples of accounting estimates which require fair value estimates? What are they? Like for example, complex financial instruments which are not traded in an active and open market. Financial instruments like your company has invested in the shares, your company has invested in the mutual funds, your company has invested in other stock market investments, or they have invested in the derivative contracts like futures, options, calls. So in these cases, we have to do the valuation of these kind of instruments on the basis of fair value. So this is one accounting estimate where we use fair value. Or share-based payments. Sir, what are share-based payments? Let me give you an example. Take for example, one startup is there. There is one management consultant for this startup. So there is one management consultancy firm. This management consultancy firm has agreed to help the startup to expand and scale their business. But these management consultancy firm, when they provide this consultancy services for the startup, they expect a fees, no? They expect a remuneration, no? But in the today's environment, what is happening is, in the startup environment, what is happening is, one management consultancy firm will come up. They will come up and say, we will provide all the consultancy services for the startup, and you have to pay us remuneration. But how you have to pay the remuneration is, the remuneration will depend on the increase in the share price. Whatever your value of the business is there. For example, we provide consultancy services for 1 year. After 1 year, whatever your market value of the startup is there, in that 1% fees we want. In that 1%, you have to calculate that you have to give it as fees. Here, this is a share-based payment. These kind of payments, we call them as share-based payments. Even in startups, for employees also, these kind of packages will be offered. So like CEO, CFO, these kind of people will join the startup, and they will have an agreement. They have to pay the remuneration for these employees or CEO, CFO. But they will say, you have to pay us a remuneration depending on the market value of your startup after certain period of time. So this we call it as share-based payments. See, you might be paying them remuneration after 1 year, depending on what is the market value. But today itself, you have to create the provision, no? How you will create the provision for this share-based payments? You will create the provision on the basis of estimating what will be the market value of that shares, what will be the fair value of that shares. Able to understand? So share-based payments are also one of the examples of accounting estimates where we are going to make use of fair value accounting estimates. Property, plant or equipment held for disposal. If you are holding any property, plant or equipment with the intention of selling it, you have to determine its value. So how you will determine the value? Depending on the current market prices. And certain assets or certain assets or liabilities acquired in a business combination, including goodwill and intangible assets. If you have to calculate the goodwill will be determined on the basis of the market value. So calculation of the goodwill is also an accounting estimate, and that to a fair value accounting estimate. Not just that, transactions involving exchange of assets or liabilities between the independent parties without the monetary consideration. For example, a non-monetary exchange of plant facilities in different lines of business, nothing but barter transactions. If any barter transaction is happening, like for example, one company is there, your client company X Limited is there. So what they are doing is, they are providing some services. They are providing some services to another entity, Y Limited. But they are not receiving the consideration in the form of cash. They are receiving the consideration in the form of goods. So now, if you are conducting audit of this client X Limited, the management of this client X Limited, they have to recognize revenue. Whatever services they have provided to another entity, for these services, they have to recognize revenue. But at what value they will recognize the revenue, sir? At what value they will recognize revenue? See, if they have received the cash or money through the check, they can tell, okay, this much value of revenue we can recognize. But it is a simple barter transaction. You have provided the services, and in return, you have purchased the goods. Now, how to recognize a revenue transaction? At what value you will recognize revenue? Now what you should do is, you should determine what is the current market value. You have to estimate what is the current market value of the goods, whatever you have received, and that you have to recognize it as revenue. How you will determine what is the current market value of the goods? Depending on the current market prices between the parties. So once again, you are bringing in fair value concept here. So this is also one such example of the accounting estimate where fair value accounting estimates are getting used. So these are few examples of the situations where we use fair value accounting estimates. Similarly, we have various other accounting estimates also where we do not use fair value, where we do not pay attention to what are the current market prices and all. There are we don't pay attention to that. There are some various other accounting estimates other than fair value accounting estimates. What are they? Allowance for doubtful debts. We don't pay attention to any market prices and all. So that's why allowance for doubtful debts is a non-fair value accounting estimate. Inventory obsolescence, nothing but, for example, if your client is having some 1 crore worth of stock. Now in this 1 crore worth of stock, at least some quantity of the stock would have damaged. So generally, as on the balance sheet date, what management will do is they will estimate out of this 1 crore worth of stock how much percentage of inventory might have been damaged. They will not exactly calculate how much amount has been damaged, but depending upon the condition of the stock and all, they will determine certain percentage. Okay, out of this entire inventory, this certain percentage of inventory might get damaged. So that we call it as provision for inventory obsolescence. For determining that inventory obsolescence also, the company will not use the current market prices and all. Mainly they use the past data for making that estimation. Warranty obligations also not depending on market prices. It depends on the contractual terms and conditions, what kind of contracts you are having with your customers. On that basis, they are going to determine warranty obligation. They will not pay any attention to what is the current market value and all. Depreciation method is also an accounting estimate other than fair value. What is the useful life? What is residual value? So this is also something which is other than fair value accounting estimate. Provision against carrying amount of investments where there is an uncertainty regarding its recoverability. Nothing but sometimes as per the Ind AS for some financial instruments, you are required to create a provision. And for the calculation of that provision also, that depending on non-recoverability, not on market values. Outcome of a long-term contracts, when the company is having a long-term contract, out of that they have to create a provision. That is also something, an example of other than fair value accounting estimate. Or financial obligation cost arising from litigation, settlement and judgments. This is also one example where other than fair value accounting estimates will be used. So that's what they are telling in the definition. So the definition says accounting estimate is an approximate amount of monetary amount in the absence of precise measurement, and it can be of two types, which require fair value, which does not require fair value. Next one, what is estimation uncertainty? This definition is very, very important. What is estimation uncertainty? Let us see what they are telling. Estimation uncertainty, the susceptibility of an accounting estimate and related disclosure to an inherent lack of precision in its measurement. So basically, whatever estimate you are calculating, you are not calculating it precisely. So there is always a chance that whatever provision that you have created, whatever actual outcomes comes out of that provision, that might always have a mismatch. That possibility, that chance only, we call it as estimation uncertainty. Uncertainty means what? We don't know what exactly will be the outcome. Since we don't know what is the exact outcome of that, that's why we are creating a provision. And when that actual thing happens, that might be different from accounting estimate. That susceptibility will always be there, that risk will always be there. So that only we call it as estimation uncertainty. That only we call it as estimation uncertainty. And now when you come here, there are some accounting estimates which involve low estimation uncertainty. There are some accounting estimates which involve high estimation uncertainty. What do you mean by accounting estimates involving low estimation uncertainty? Which means in some cases you calculate a provision, and in most of the cases whatever actual outcome is there, that will lie close to the provision only. There will not be much gap. So there will be some accounting estimates which involve low estimation uncertainty. There will be some accounting estimates which involve high estimation uncertainty. Which means, for example, what do you mean by high estimation uncertainty? Sometimes you calculate a provision, but when actually the things come out, the difference between the provision and actual things is very huge. For example, you created a provision for 1 crore, but actual expense turned out to be 2 crores. Here there is a high estimation uncertainty. So like this, some accounting estimates will have a high estimation uncertainty. Some accounting estimates will have a low estimation uncertainty. Let us see which accounting estimates will have high estimation certainty and low estimation certainty. Some accounting estimates involve relatively low estimation uncertainty and give rise to low risk of material misstatement. As I have told, wherever estimation certainty is higher, high risk of material misstatement. Wherever estimation certainty is lower, there will be a low risk of material misstatement. Yes or no? Do agree with my statement? See, what they're trying to say here is, if certain items involve high risk of material misstatement, like for example, high chance of going wrong. For example, you take warranty obligation. In case of warranty obligation, the management will estimate how many number of customers will come and claim for warranty. They have created a provision for that. But actually, that many number of customers might turn up, might not turn up. It all depends on facts and circumstances. Here I will say, whatever warranty provision that you have created, there is a high chance that this provision might differ more from whatever actual warranty claims that will happen in the future. That means I will say here high estimation uncertainty. There is a high estimation uncertainty here. That means there is a chance of huge gap between the warranty provision that you have created and the actual warranty outcome. So here there is a high estimation uncertainty. Since the uncertainty is very high, the risk is also very high. The chances of happening misstatement in this area is also very high. On the other hand, you have created from provision for expenses. For example, electricity expense provision you are creating. For the month of March, you have created a provision for electricity expense. See, for the last 11 months, we have incurred electricity expenses. More or less, March month expense also will happen in the same range. For example, on an average, for the last few months, on an average, monthly average, the company is paying a electricity bill of 15 lakh rupees. So for the month of March also, they have created a provision for 50 lakhs. Now you tell me, when the actual outcome comes, is there a more estimation uncertainty here, less estimation uncertainty? Here there will be less estimation uncertainty. Why, sir? Why? Because it is based on informed data. It is based on informed data. Like for example, here the actual expense might turn out to be 15.2 lakhs. 15.2 lakhs estimation. The chance of this estimation going wrong is very, very low. So here there is low estimation uncertainty is there. Whenever there is low estimation uncertainty, the risk of material misstatement is also going to be low. Clear? So that's what they are trying to say here. So if we start reading it, some accounting estimates involve relatively lower estimation uncertainty and may give rise to low risk of material misstatement. When estimation certainty is lower, risk of material misstatement also will be lower. When estimation certainty is higher, risk of material misstatement also will be higher. Sir, what are the accounting estimates which involve low estimation uncertainty? Number one, accounting estimates arising in entities that engage in business activities that are not at all complex. For example, if the company is engaging in transactions which are very, very simple, like for example, your client is a FMCG company. FMCG transactions are very simple. You buy the goods, pay the money, take it out. For example, if you take IT company, in IT company, revenue recognition is very difficult. Why? Because IT contracts are very complex. So if the nature of business activities of the client are very complex, there will be high estimation uncertainty. On the other hand, if in case of FMCG business, the transactions are not at all complex. The transaction is a simple business. There, the estimation certainty will be lower. So first thing, where accounting estimates will be having low uncertainty is accounting estimates arising in entities that engage in the business activities that are not complex. You can write here FMCG versus IT. Where there will be high estimation certainty, there will be high estimation uncertainty in the case of IT companies than when compared with FMCG. Why? Because FMCG business is very simple. IT business is very complex. Next one. Accounting estimates that are frequently made and updated because they relate to routine transactions. If you are creating an accounting estimate for a routine transaction, if you are creating an accounting estimate for a routine transaction, that means you are doing it very frequently. Every year you will definitely create this provision. That means you have already a lot of experience in creating that provision. There will be low estimation uncertainty. Once in a while you have to create a provision. Like for example, you take litigation. Litigations will not happen every year. Litigation once in a while it will happen. So if you are not doing something with routine frequency, there will be a high estimation uncertainty. But if you take provision for expenses, we do it very frequently. Month on month we do it. So then there will be low estimation uncertainty. Third one, accounting estimates derived from data that is readily available, such as published interest rates or exchange traded prices of securities. Such data may be referred to as observable. See, I told that sometimes fair value estimates you have to do. Like for example, you have to value the securities. If the company has made investments, that investments are required to be valued at fair value. But in case if you have listed securities, determining fair value is very easy. Why? Because you will have stock market, you will have the prices getting traded in the stock market. From the stock market, readily traded price will be available. That price you can take and determine fair value. So here there will be low estimation uncertainty. So those accounting estimates which are derived from data that is readily available, such as published interest rate data or exchange traded prices of securities, nothing but that data we call it as observable data. So if you are calculating provisions on the basis of readily available observable data, then that estimates also carry low estimation uncertainty. Similarly, fair value accounting estimates, where the method of measurement prescribed by the applicable financial reporting framework is very simple and applied easily. Sometimes Ind AS itself will say how you have to calculate the accounting estimate, exact method they will say. So when the method which has been suggested in the accounting standards, it's very simple. They have given some two simple steps. If you follow, just to follow these two steps and determine the accounting estimate, that means the method or model for calculating the accounting estimate has been given in applicable financial reporting framework itself, and that method is very simple, straightforward method. So when the method is very simple, when the method is very straightforward, you can easily calculate it with some just 2-3 steps. Their estimation certainty will be lower. In some cases, what will happen, the accounting standards will tell you method for calculating accounting estimate, but that method will be very complex, which a common man cannot understand, which you require help of some experts. Their estimation certainty will be very high. On the other hand, when method is very simple, it involves just some simple math like additions, deletion, subtraction, division, and you can easily arrive at that accounting estimate. If the method is very simple, very easy to understand, there will be low estimation certainty. When the method is very complex, when the method which has been suggested in the applicable financial reporting framework is difficult to understand, difficult to interpret, then there will be high estimation uncertainty. Similarly, fair value accounting estimates, where the model used to measure the accounting estimate is well known or generally accepted. Once again, repeated point. Fourth and fifth are repeated points actually. So when accounting estimate model, method or model, you can say anything, when the model given under the applicable financial reporting framework is well known and generally accepted. Clear? So if you have a look at the summary here, what we have seen till now. So did we complete the objective? Yes, we completed this objective part. Have we seen the definitions? Which definitions we have seen? We have seen what is the meaning of accounting estimate, what is the meaning of outcome, what is the meaning of, this we did not see. We have seen what is the meaning of estimation uncertainty. We have seen what is the outcome. I think this also we did not see. Outcome also we are yet to see. In the definitions part, two definitions we have seen. What is accounting estimate? What is estimation uncertainty? Then talking about nature of accounting estimates, we have seen which accounting estimates will involve low estimation uncertainty. What are the examples of situations where you will use fair value accounting estimates? What are the examples of situations where you will use other than fair value accounting estimates? So all these things we have seen. Now let us have a look at the material once again. So we have seen accounting estimates which involve low estimation uncertainty. Now let us have a look at those accounting estimate examples which have high estimation uncertainty. Let us see. For some accounting estimates, however, there may be relatively high estimation uncertainty, particularly when they are based on significant assumptions. Like for example, accounting estimate relating to an outcome of litigation. If you have to calculate an accounting estimate regarding a litigation, since it is a non-routine in nature, there the estimation uncertainty is very, very high. Why? Because there even court judgment is involved, which is beyond your control. So example of accounting estimate which involve high estimation uncertainty is accounting estimate relating to outcome of a litigation, or fair value accounting estimate for derivative instruments which are not publicly traded. For example, if your client is entering into some call option, put option or futures and out of the stock market, that means there will not be readily available prices for determining fair value. You have to study the current market terms and conditions and all. So when you are dealing in those instruments which are not publicly traded, they are also accounting estimates are having a high chance of estimation uncertainty. And fair value accounting estimates for which highly specialized entity developed model is used, for which there are assumptions or inputs that cannot be observed in the marketplace. See, that is exactly opposite of the previous thing. Here I told when the fair value method is very simple, very straightforward, very easily applied, then there is a low estimation uncertainty. On the other hand, the method is very highly specialized method. It is entity developed method, which is not that easy to understand. Then that carries a what? High estimation uncertainty. Clear, everybody? Able to understand? And so whether estimation certainty will be higher or will be lower, that depends on various factors. That depends on the nature of the accounting estimate, like whether it is complex or not complex. It also depends on the extent to which there is a generally accepted method is used, whether the method which you are what method you are using for the purpose of determining accounting estimate. That also will determine estimation uncertainty, and also subjectivity of the assumption. That means how much personal bias is involved. If more personal opinion is there in deciding an accounting estimate, more uncertainty will be there. Less opinion is involved in determining judgment, less will be the estimation uncertainty. Like for example, in some cases, more personal opinions are involved in making an estimate. For example, litigation. Litigation is such a area, it is completely depending on personal opinion. Whether company will win the case or lose the case, it is a personal opinion. So there will be estimation uncertainty is much higher. In some areas, subjectivity will not be there. Like for example, provision for expenses. Provision for expenses, there is no personal opinion. We create provision for expenses on the basis of past data. There the estimation certainty will be lower. Nothing but this is a summary. So we are telling in some areas estimation certainty will be low, in some areas estimation certainty will be high. Now they are giving a conclusion. Generally, whether estimation certainty will be high or will be low, it depends on three factors. What are the three factors? It depends on the nature of accounting estimate. It depends on what method you are using for determining accounting estimate. It also depends on how much subjectivity, how much bias is involved in determining that accounting estimate. Clear? Able to understand everybody? So with this, we are done with this as well. Okay, so we have seen accounting estimate definition, and we have seen different types of accounting estimates. We have seen estimation uncertainty. We have seen examples of those accounting estimates which have high estimation uncertainty, which have low estimation uncertainty. Next, let us come to the next definition: outcome of an accounting estimate. Sir, what do you mean by outcome of an accounting estimate? Let us see. The actual monetary amount which results from the resolution of the underlying transaction, event or condition addressed by the accounting estimate. Because of whatever event you have created an accounting estimate, since you don't know with accuracy, since you have created that accounting estimate, at certain point of time in the future, that event will resolve. That event will turn out to be a reality. At that point of time, you will come to know what is the actual amount, actual monetary amount you will come to know. So that actual monetary amount which you came to know after resolution of that event, after resolution of that uncertainty, whatever actual monetary amount that you have got, that we call it as outcome of an accounting estimate. So the actual monetary amount which results from the resolution of underlying transaction, event, condition addressed by accounting estimate. For example, I created a provision for expenses of 10 lakh rupees because I don't know exactly what is the figure. After a certain point of time, that expense has turned out to be a reality. That actual expense came to 9 lakh rupees. So this 9 lakh rupees, we call it as outcome of an accounting estimate. And as I have told, if there is a difference between accounting estimate and outcome of an accounting estimate, can we call that as misstatement? No, we cannot call that as a misstatement. Understood everybody? So this is what the definition of outcome of the accounting estimate. So now I would like to explain one more thing. So come here. The measurement objective of accounting estimate. What is the measurement objective of accounting estimate? When we are measuring the accounting estimates, what will be the objective? See, for some accounting estimates, we determine some accounting estimate. When we are calculating some accounting estimates, the purpose of that accounting estimate, the objective of that accounting estimate is to forecast the future. Some accounting estimates, when we are calculating, there our objective will be to forecast the future and determine the impact. Whereas for some accounting estimates, we are not going to forecast the future. We are going to just determine the current condition, and we are going to forecast, and we are going to determine the current condition, and we are going to calculate the estimate. Not able to understand? Let us read it. You will get the better understanding. If I read this paragraph, you will get better understanding. The measurement objective of accounting estimate can vary depending on applicable financial reporting framework and financial item being reported. See, what is the meaning of, first of all, measurement objective? What is the objective of you to calculate this provision? Why you are calculating this accounting estimate? What is your objective for measurement? What exactly you want to calculate through this accounting estimate? That is what we call it as measurement objective. So write it here. What you want to measure. What you want to measure through that accounting estimate. So what you are trying to calculate through that accounting estimate, it depends on applicable financial reporting framework, and it depends on the financial item which is being reported. So if you see here, the measurement or objective for some accounting estimates is to forecast the outcome of one or more transactions, events or conditions, giving rise to the need for accounting estimate. So when we are calculating some accounting estimates, there our objective is to forecast what is the effect of the future events which is going to happen and calculate the estimate. Like for example, if I have to give example for you, warranty provisions. Warranty provisions. See, when you are calculating warranty provision, what is your objective? What exactly you are trying to calculate? You are trying to forecast the outcome of one or more transactions in the future. In the future, how many customers will come and claim the warranty? How much expenditure I have to incur in the future? That is what you want to measure. So for some accounting estimates, the measurement objective will be to forecast the outcome of one or more transactions. Forecasting means what? Estimating, projecting, estimating the outcome of one or more future transactions, that is giving rise to the need for accounting estimate. Whereas for other accounting estimates, including many fair value accounting estimates, the measurement objective is different and is generally expressed in terms of value of the current transaction or financial statement based on conditions prevalent at the measurement date. Like for example, if you take NRV calculation, NRV is also an accounting estimate. When you are calculating NRV as an accounting estimate, there what you are exactly trying to calculate? When calculating NRV, you are not trying to project any future. Just as on the balance sheet date, what will be the current value of that in the prevailing conditions, that you are measuring and you are showing it as NRV. So for some accounting estimates, when we are calculating certain accounting estimates, there our objective will be to predict the future and determine the value. On the other hand, when we are calculating some other accounting estimates, we will not discount the future. We will calculate that accounting estimate on the basis of current market terms and conditions. So write the examples here. You will understand it better in the future. You will not get confused. See, the problem with this accounting standard is terminology. The terminology is very complex. The sentence formation which they use in the standard is very complex. That's why at various places I am making the use of these examples. So write these examples. So warranty provision is forecast for the future. Here you write your NRV. When you are determining NRV, you are not determining any future. You are just calculating on the current prevailing terms and conditions as on particular date, particularly as on balance sheet date. And this statement is very, very important. Damn important it is going to be. A difference between the outcome of an accounting estimate and the amount originally recognized or disclosed in the financial statements does not necessarily represent a misstatement in the financial statements. So whatever estimate that you have created and what is the actual outcome of that accounting estimate, if both are not matching, that we can't call it as a misstatement. This I have told you repeated number of times. Why? Because this is going to be very, very important. Next one. Let us come to the next part. Okay, so this definition is also done. Outcome of accounting estimate also we are done. Now, management point estimate. Few more definitions they are telling. What is management point estimate? Nothing but, if I read the definition, the amount selected by the management for recognition or disclosure in the financial statements as an accounting estimate. Nothing but, as I have told, management will consider various factors, like they will consider the past data, they will do some assumptions, they will read the contracts, they will have the discussions, after they will even consult experts. After doing all this, after considering all these factors, management will determine one amount. No, for example, this much amount of provision I will create. That amount determined by the management for recognition in the financial statements, that we call it as management's point estimate. The amount which has been selected or determined by the management after considering all these factors, whatever final figure that the management has derived for the recognition or disclosure in the financial statements as an accounting estimate, that determined figure, that calculated figure of accounting estimate, we call it as management's point estimate. Then we have one more definition, auditor's point estimate or auditor's range. So now what is this? Now what is this is, see, take for example, management, they want to create a provision for warranty obligation. Management want to create a provision for warranty obligation. Now what they will do is, as I have told, they will study the past data, they will study the assumptions, they will study the warranty contracts, all this they will study, and they will determine a particular amount. For example, they have, after doing all the calculations, they have determined that 1 crore amount of warranty provision they will create. So this is management's point estimate. Management's point estimate. This calculated figure is management's point estimate. Now, whether this estimation is correct or not, whether the accounting estimate calculated by the management is correct or not, to determine that, auditor can do two things. Auditor also can go through the past contracts, he can also make use of the assumptions, he can also use some methods, and he can also, using his evidence, using his knowledge, he can determine certain figure. Okay, depending upon the current market conditions, depending on the nature of the industry, depending upon the contracts, depending on the past experience, this entity should have created this much amount of warranty provision. Like for example, auditor did all the calculation, auditor also considered various factors, and he determined that for this industry, for this client company, this much amount of provision should have been correct. So this is the estimate which has been developed by the client, exact figure which has been developed by the client to evaluate management's point estimate. In some cases, what auditor will do is, he will not determine the exact figure, he will develop a range. Like for example, the auditor will feel that depending upon this industry, for example, client is selling mobile phones. Depending on the mobile industry, depending upon nature of the brands they are selling, depending upon the customer complaints, depending on the period of warranty, the auditor felt that for this industry, for this kind of company, this warranty provision should be in the range of 90 lakh rupees to 1 crore. So this we call it as auditor's range. So management will not determine range. Management will always calculate exact amount which required to be recognized in the statement of P&L or balance sheet. But in order to evaluate whether this management's point estimate is correct or not, auditor can do two things. Either he will develop a point estimate like the management. He will also consider all the evidence. He will exactly develop this much amount of figure will be appropriate. Or sometimes instead of determining the exact figure, what auditor also can do is he can develop a range using all his evidence. He can develop a range, and within that range, whether that provision created by the management is falling or not, he will check. So that's why management will always create a point estimate. But in order to evaluate whether these management calculations are correct or not, auditor can do two things. Either he can develop a point estimate or he can develop a range estimate. Clear? So that's what they say here. The amount or range of amounts respectively derived from audit evidence for use in evaluating management's point estimate. So always you have to remember one thing: management will always determine exact figure, point estimate they will do. But to evaluate whether that management's estimate is correct or not, auditor can even calculate point estimate, or he can calculate a range estimate. So that is what the meaning of auditor's point estimate, management's point estimate. Next one, management bias. What is management bias? See, when it comes to management bias, what they are trying to say here is, take for example, debtors are there. Okay. Out of the debtor, there is one debtor, Mr. A. He is required to pay 10 crore rupees of money to the company. 10 crore rupees of money to the company. Now, this debtor's financial position is bad. This debtor's financial position is bad. When the debtor's financial position is bad, what management should do? They should recognize a provision for bad and doubtful debts. Now what management will do? They will study the past data. They will analyze what is his current financial position. They will make the inquiries in the market. They will even go and discuss with the debtor. And finally, they thought that the management, as per the management, they thought that 40% creation of provision will be suitable. The financial position of this debtor is very bad. 60% he is having significant assets, but that assets will be able to fetch only 60% of the value outstanding. So 40% they will not be able to fetch it. 40% they will not be able to fetch it. Now, if the management says that, if the management finds that 40% of the amount might not be recoverable, they should have created provision for 4 crore rupees. They should have created provision for 4 crore rupees. But management is thinking something like this: if I create a provision for 4 crore rupees, that will even go into my statement of P&L also. If I create a provision for 4 crore rupees, that will go into my statement of P&L also. That means my profit of the current year will fall by 4 crores. My profit of the current year will fall by 4 crores. Let me do one thing. It is just a estimate. No, it is just a estimate. I will do one thing. I will not estimate. I will change my estimate now. See, by the end of the day, accounting estimate just a matter of your assumption. So what the management is doing is, as per if they go by their genuine assumption, they should have created a provision of 4 crore rupees. But what management is thinking is, if I show the provision as 4 crore rupees, my P&L will be hit. Let me do one thing. Let me change my assumption. I will assume it as only 30% is not recoverable. I will create a provision of only 3 crore rupees, so that if I do that, the profit will not be come down by 4 crore rupees. The profit will come down only by 3 crore rupees. Now you tell me, the management, while creating this accounting estimate, while calculating this accounting estimate, did they calculate this accounting estimate in an unbiased manner, or they have shown some bias? They have shown the bias here. Why they have shown the bias? They are not neutral basically. When they are neutral, what they should have done is, if the management is neutral, what they should have done is, whether it is whatever may be the impact on the profit, I have to take the genuine assumption and calculate an estimate. That is what the management would have done if they are neutral. But here they are not neutral. They are more biased here. They don't want their profits to come down. So that's why they are more biased. Instead of making an assumption, a genuine assumption of 40% being not recoverable, they are making an assumption only 30% is not recoverable, and they have created a under provision. Why, sir? What is the intention behind it? Because of this wrong assumption, they want to manipulate the picture shown by the financial statements. So this we call it as management bias. Lack of neutrality of the management while making an accounting estimate. See, same thing can happen even in the depreciation also. For example, the company has bought a plant and machinery. Genuinely, the useful life could be 5 years. On the basis of past experience, they could estimate the useful life to be 5 years. But the management want to show more profits over a period of time. So what they are doing is when the acceptable estimated useful life is 5 years, but instead of that they are treating the useful life as 10 years and calculating depreciation, so that year on year the depreciation expense will be less, year on year the profit will be little bit higher. Yes or no? So here also what the management is doing, instead of making a genuine assumption of 5 crore rupees, they are making a biased selection. They are being not neutral. They are showing bias towards 10 years of useful life in order to manipulate the picture shown by financial statements. So this we are going to call it as management bias. So let us see what else they are trying to say here. Management bias, a lack of neutrality by the management in the preparation and presentation of information. That means management is not behaving in a neutral manner. They are showing bias while calculating, while preparing and presenting the information. So that we call it as management bias. Now we have some information regarding management bias in accounting estimates. Let us see. So what they are trying to say here. Financial reporting framework often calls for neutrality, that is freedom from bias. Always the applicable accounting standards give importance to neutrality. Even Ind AS and also say that when the management is making an accounting estimate, they have to make the assumptions in an unbiased manner, in a neutral manner. They have to make assumptions. They should not show any kind of bias. So applicable financial reporting framework, that is Ind AS and accounting standards, always call for neutrality. Accounting estimates are imprecise, that we all know. Accounting estimates we can't exactly calculate. However, they can be influenced by management judgment. But what management can do is, to achieve their own benefits, they will try to manipulate that decisions. Such a judgment may involve unintentional or intentional management bias. For example, by mistake management can make a bias, or in some cases intentionally management want to show the bias. The susceptibility of an accounting estimate to management bias increases with the subjectivity involved. Higher the personal opinion is involved, higher will be the chances for bias. If there is no scope for your personal opinion in determining the judgment, in determining the assumption, then the bias will be less. But more personal opinion is involved, more will be the bias. Unintentional management bias and the potential for intentional management bias are inherent in subjective decisions that are often required in making an accounting estimate. That means we can't say there will not be bias at all. The risk of bias will always be there. Whenever you are making a subjective decision, whenever you are making a assumption itself is depending on personal opinions. No, so there will always be risk. I'm not telling bias will never be there in accounting estimate. The risk will always be there, but the management should try to mitigate that risk of bias by making proper judgments. But always the risk is inherent. So unintentional bias or intentional bias are inherent. That will be built in the system only. Why? Because when we are making assumptions, we are making judgments. So judgments, we can always show some bias. That risk will always be there, but management should try to overcome that by making proper and genuine assumptions. For continuing audits, indicators of possible management bias identified during the audit of the preceding years influence the planning and risk identification and assessment of current year. Nothing but if you have done the audit of the prior year also, whatever information that you have obtained in the last year, that you can use it even in the current year also for determining whether bias is there or not. Management bias can be difficult to detect at an account level. It may be identified when considered an aggregate of group of accounting estimates or all accounting estimates. See, whether management is biased or not, it is very difficult to determine at each item. But on an overall basis, when we look at overall accounting estimates collectively we can determine whether management is biased or unbiased. At a very individual level, for example, management is required to create a total of 20 provisions. Management is required to create a total of 20 provisions. So what they will do is, at each individual provision level, they will make a little amount of bias, small bias they will make. For example, if useful life is 5 years, they will change it to 6 years. Very little bias, which is very difficult to find. But when you take the collective effect of the entire provision, for example, last year the total provisions put together are 1 crore. In the current year, the total provisions put together, they are coming to 30 crore rupees. So now you can more find out the bias. So at the individual item level, it is very difficult to find out the bias, but at a group level, at a collective level, we can easily determine whether there is a bias or not. Although some form of management bias is inherent in subjective decisions in making judgments, there may be no intention by the management to mislead the users of the financial statements. See, whenever the management has selected wrong assumption, it is not always with the intention of cheating. Sometimes because of management unawareness also, they might make a bias here. That means when there is a bias in the selection of accounting estimates, that could be because of intentional reasons to cheat the users. Sometimes it could be unintentional, simply without any malicious intention. By mistake, they might have used a wrong assumption. That also could happen. However, when you find that there is an intention specifically while selecting the accounting estimates, then it is definitely fraudulent in nature. When you find intention, this we all know, this we are seeing it from the beginning of our discussion. When something is done intentionally, it is fraudulent. When something happens by mistake, it is simply an error. Understood? So this is what regarding management bias, not that important from the examination perspective. Just give one reading and ignore it. No need to remember it. So this is what we have seen regarding accounting estimates. So this is what we have seen regarding management bias. So with this, all the definitions we are done. With this, all the definitions we are done. So let us see what else we are pending, what else we are having as pending. So objectives we are done, definitions we are done, nature of accounting estimates we have seen. Some accounting estimates uncertainty is low, some accounting estimates uncertainty is high. Degree of estimation uncertainty depends on certain factors. What are the examples of accounting estimates which involve fair value? What are the accounting estimates which does not involve fair value? All this we have seen. Then they say one more item here. Not all financial statement items requiring measurement at fair value involve estimation uncertainty. See, previously I told that we have accounting estimates which are derived on the basis of fair value also. We have accounting estimates which are derived on the basis of other than fair value also. Where there is a high risk, actually, where there is a high estimation uncertainty, whenever there is a fair value usage, there will be high estimation uncertainty generally. But there is an exception. There is an exception. Not all items which involve fair value carry estimation uncertainty. There will be some accounting estimates which involve a fair value adjustments, but still they might not have high estimation uncertainty. Take for example, investments. The company has made investments, and these investments are required to be measured as on the balance sheet at fair value. For example, company has invested in the shares of another company as on the balance sheet date. These shares are required to be measured at the fair value. So valuation of shares involve fair value measurement. But these shares are listed in the stock exchange. These shares are listed in the stock exchange. In the stock exchange, as on the balance sheet date, the price at which the shares are quoted is 99 rupees. Now these shares will be valued. For example, company is having 10,000 shares that has been valued at the fair value of 99 rupees. Totally 9.9 lakh rupees of investment was recognized as on the balance sheet date. Now this is an item of the financial statement which involves fair value estimate. But here the estimation uncertainty will be low. Estimation uncertainty will be low. Why estimation uncertainty is low? Why? Because since here the investments are listed or quoted on the stock exchange, we are actually taking the price from the stock exchange. So the chances for this decision going wrong, or the chances for this accounting estimate going wrong, are high. Able to understand? Why? Because yes, this is an accounting estimate which involved fair value, but estimation uncertainty is lower. Why? Because we calculated on the basis of readily available figures available in the market. So generally, whenever accounting estimates involve fair value, there is a little bit of high degree of estimation uncertainty, except in some cases. In these cases, like when the fair values are readily available on the market prices, when those investments are traded on the stock exchanges, in those cases, even though those estimates are based on fair value, the estimation uncertainty will be little bit lower. Very general paragraph, not that important from the examination perspective, but anyhow we will quickly see it. Not all financial statement items requiring measurement at fair value involve estimation uncertainty. This may be the case for some financial statement items where there is an active and open market that provides readily available and reliable information on the prices at which actual exchanges occur, in which the existence of published price quotations ordinarily is the best evidence of the fair value. Like as I have told, especially in the case of investments which are required to be measured at fair value, we can take that fair value figure from the stock prices which are traded in the stock market. However, estimation uncertainty may exist even when the valuation method and data are well defined. But in some cases, what will happen is, but in rest of the other fair value estimates, there will always be uncertainty. That's what they are telling. Only for some items which involve fair value estimates, there will be less estimation uncertainty. But for rest of the methods, wherever which involves a fair value, in rest of the cases, there it will be estimation uncertainty will be there. Only in a few limited cases, that too when the fair values are taken from the stock market prices which are traded on the stock exchanges and all, in those cases only, even though the accounting estimate involve fair values, estimation certainty will be lower, whereas in rest of the cases where fair values are there, their estimation certainty will be little bit higher. Understood? So this is what regarding 7th point. This D anyhow we are done with. Measurement of accounting estimate, this also we are done with. Now, what is auditor's responsibility? What will be auditor's responsibility regarding accounting estimates? Till now, whatever we have seen, that is completely from the management perspective. But as we know, standards on auditing will be talking about auditor's responsibilities. Let us see what will be the auditor's responsibility regarding accounting estimate. As I have told, first auditor should perform risk assessment procedures, then he should try to perform further audit procedures. So now basically they talk about risk assessment procedure. Mainly they are talking about risk assessment procedure. So what is auditor's responsibility when he is performing risk assessment procedure and related activities? What he should do? So if we start reading it, when performing risk assessment procedure and related activities to obtain an understanding of the entity and its environment. So this I will try to cover it from the chart. Okay. This one. So what is auditor's responsibility regarding accounting estimates? What auditor is supposed to do regarding accounting estimates? First, as I have told, when you are performing risk assessment procedures and related activities, you should try to understand what things you try to understand. Let us see. When performing risk assessment procedures, the auditor shall obtain an understanding of the following for identification of risk of material misstatement regarding accounting estimates. So when you are at the beginning, when you perform risk assessment procedures, when you try to obtain an understanding of entity, environment and its internal control, you should also try to find out, is there any risk of material misstatement relating to accounting estimate? Sir, how I will come to know whether accounting estimates carry risk of material misstatement? First, you should understand what are the requirements of applicable financial reporting framework. What does the applicable financial reporting framework say regarding accounting estimate? What accounting methods they are prescribing? What disclosure requirements they are prescribing? That you need to understand it. So first you should understand the requirements of applicable financial reporting framework like Ind AS and AS, what they are saying regarding accounting estimates, what accounting requirements they are prescribing, what disclosure requirements they are prescribing. First you should understand those requirements. Number one. Number two, how management identifies those transactions, events and conditions that may give rise to need for accounting estimate. So once you understood what are the requirements of applicable financial reporting framework, then as an auditor, you should understand how management has determined the items in the financial statements which require accounting estimates. Nothing but management should make a list of all the items which require accounting estimates. Go and ask the management how they have identified all those items which require accounting estimates. Next, in obtaining this understanding, the auditor shall make inquiries of the management about changes in the circumstances that may give rise to new or need to revise the existing accounting estimates. Sometimes what will happen is management will create the accounting estimate, but because of some circumstances, because of change in circumstances, the management might be required to revise the accounting estimates. So go and inquire with the management, did they revise the accounting estimates? Did they come across any such circumstances which require a revision in the accounting estimate? If yes, have they revised it? And as the assessment of accounting estimates affects the ultimate decision in forming an opinion, much care has to be taken in this regard. Nothing but since in the area of accounting estimates, there is a high chance of misstatement happening, you have to be more careful when you are obtaining audit evidence regarding accounting estimates. So this is the first responsibility. While performing risk assessment procedure, you need to understand the requirements of applicable financial reporting framework. You need to understand how the management has identified those items which require accounting estimates, and you have to do the inquiries of the management. And since it is a critical area, you need to pay more attention. Now I told, as an auditor, you need to understand how management identifies events or transactions that need accounting estimates. No, how we can do it specifically in a detailed manner. They have told. As an auditor, whatever has been told here, as an auditor, you need to understand how management identifies transactions, events and conditions which give rise to need for accounting estimate. Sir, how you will exactly identify, sir? How you will obtain an understanding of which items of the financial statements require accounting estimate? How the management will identify it? As an auditor, how you will understand it? Let us see. In preparing the financial statements, the management has a responsibility to determine transactions or events or conditions that give rise to the need to make an accounting estimate. So the management, while preparing financial statements, they have an obligation to determine which areas require accounting estimate. And they also have the responsibility to make sure that all necessary accounting estimates have been recognized, measured, and disclosed in the financial statements in accordance with applicable financial reporting framework. First, they are talking about management responsibilities. So as the management of every organization will have the responsibility to identify all those events or transactions which require accounting estimate. And it is the responsibility of the management to make sure that all the accounting estimates are accounted and disclosed as per the requirements of applicable financial reporting framework. Now, The auditor's risk assessment procedure assists the auditor in identifying circumstances or change in the circumstances that may give rise to risk of material misstatement. And as an auditor, when you perform the risk assessment procedures properly, you can betterly identify the risk of material misstatement regarding accounting estimate. And particularly, in order to know that, you have to do the inquiries of the management. But what exactly you have to inquire? You have to make the inquiries of the management regarding, has the entity engaged in new type of transaction that may give rise to accounting estimate? Did your client engage in new transactions which is giving rise to risk of material, which is giving rise to accounting estimates? Like for example, till now your company is not used to sell the goods under warranty, but recently in the current year only they have started offering even warranty agreements. When in the recent year only they have started giving warranty agreements, that means they have entered into a new type of transaction which brings into need the accounting estimate. Similarly, you need to inquire the management regarding the terms of the transaction that give rise to accounting estimates that have changed. Even you have to sit with the management and discuss what are the terms and conditions of the contracts. Accounting policies relating to accounting estimates have changed as a result of changes to the requirements of applicable financial reporting framework. Whatever policy you used to follow for calculating accounting estimate, had that undergone any change because of the change in the accounting standards and all? Regulatory or other changes, you should pay attention. Are there any changes in the laws and regulations which require the organization to create a accounting estimate? And even new conditions or events, whether there are any new events or conditions which has taken place in the organization which require you to make accounting estimates now. So like this, as an auditor, if you do these things, you will try to understand how the management identifies the need for accounting estimates. If you ask me personally, this is nothing but just a elaborated version of this first paragraph. So in the first paragraph, they are telling, as a part of risk assessment procedures, you need to obtain understanding regarding accounting estimates. How you can do it in a detailed manner that they have told it here. Nothing but first they have told what are management responsibilities. If you perform risk assessment procedures, what you will achieve and what exact inquiries you are supposed to do. Next one. You should also understand how the management makes the accounting estimate. So first you will try to understand how the management identified areas, how the management found out which areas require accounting estimate, how you can get it. That is the second point. Now the third point, once you have determined all the areas in which management is required to make accounting estimate, now you have to understand how the management is exactly calculating that accounting estimate. So what you will understand? So how management makes the accounting estimate and an understanding of the data on which they are based, like what is the method which is getting used or what model is getting used. What are the relevant controls? What internal controls management has implemented for determining that accounting estimate? Whether management has used an expert for the purpose of calculation of that accounting estimate? Did they use the provision or did they use the services of the expert like lawyer, actuary? The assumptions underlying the accounting estimate. What assumptions are made for the purpose of creating this estimation, for the purpose of making this estimate? Whether there has been or ought to have been a change from the prior period in the methods for making the accounting estimate, and if so, why? For example, last year for calculating an accounting estimate, you followed one policy. In the current year, the management, you have to check whatever accounting policy that has been followed in the previous year for calculating accounting estimate, the same accounting policy has also been followed in the current year. If at all you find that the management has changed their accounting policy regarding accounting estimate when compared with the previous year, we have to understand the reasons. You have to inquire the management why they have changed the accounting policy in the current year for calculating accounting estimate and what are the reasons for that changes. And whether and if so, how management has assessed the effect of estimation uncertainty. What steps management has taken to reduce that estimation uncertainty. So this also you have to understand. So how management makes the accounting estimates. And finally, estimation uncertainty. If you find that in certain area, estimation uncertainty is much higher, you need to perform some extra steps. For accounting estimates that give rise to significant risk. When generally accounting estimates give significant risk? When there is a high estimation uncertainty, high risk of material misstatement. So in those accounting estimates where estimation certainty is high, those estimates are going to be significant risk items. In those significant risk items, what you should do? You should consider how management has considered alternative assumptions or outcome. If there is a high estimation uncertainty, you should understand why the management has taken that particular assumption, why they have not considered the other assumptions. Like for example, management is creating a provision for litigation. Okay, litigation is a high risky estimate. Now, management has thought that the chances of that litigation is the company is having more chances of winning the case. So that's why they have shown it as a contingent liability. Now, as an auditor, you have to evaluate why the management has taken the assumption of they have chances of winning more. Why they have not considered the chances of losing are more. So if you find that if certain accounting estimate carry a high estimation uncertainty, you should consider how the management has considered various other alternative assumptions. So what and all different assumptions management is having possibility. Out of that, what assumption they have selected, why alternative assumptions were rejected, that you should try to understand. So how management has considered alternative assumptions or outcome, whether significant assumptions used by the management are reasonable. Take this case only. Management made an assumption that the chances of winning the case are much higher. Is that reasonable? Is that acceptable? Next one, management's intent to carry out specific course of action and its ability to do so. Whatever assumption management has made, is the management really able to carry out that assumption? For example, warranty provisions are there. Management created a warranty provision. Management thought that they will serve the customer in 1 year. Every customer, whoever is having a complaint, within 1 year, they will replace the item. On that basis, they have created a provision. Now, what the assumption management has made is they made an assumption that every customer who comes with an issue with the company within 1 year, they will replace. Is the management really having intention to do it? If it is having intention to replace the entire item, then only they should create that provision, or else they should have created a lower provision. If they are only doing the service and returning it back, lesser provision. If you are making a replacement offer, higher provision. So if the management has made an assumption that they are going to replace, really is the management having intention to carry out that? That you need to find it out. And finally, the auditor shall develop a range within which to evaluate the reasonableness of the accounting estimate. So this is what you are supposed to do in case if there is a high estimation uncertainty. And finally, on the basis of all that, you have to evaluate reasonableness of accounting estimates and determining whether there are any misstatements in the accounting estimates. That's what you are supposed to do. This is what regarding auditor's responsibility. See, basically overall responsibility they have told. First, you should understand what kind of accounting estimates are there. You have to sit with the management, how management identifies that events or transaction which require accounting estimate. Then you have to sit with the management and understand how exactly that accounting estimates are calculated. In case if you find there is a high estimation uncertainty, you should evaluate these steps. And finally, you have to evaluate the reasonableness of the entire accounting estimates and finally determine whether that accounting estimates contain any material misstatement. Clear? Next one. Sir, what audit procedures you will perform? This is just like a repetition, whatever we have seen above. What audit procedures you will perform regarding accounting estimates? This you will not find it in the main material. This you have to find. This we have to read it from this chart only. So what audit procedures regarding accounting estimates will be performed? First, you have to perform some procedures regarding identifying and assessing the risk of material misstatement. Nothing but you have to perform some procedures as a part of risk assessment procedures. And by performing that risk assessment procedure, whatever risk that you have identified, to tackle that, you have to respond to that. Nothing but you have to perform further audit procedures. So what risk assessment procedures you have to perform regarding that accounting estimates? What further audit procedures you have to perform regarding that accounting estimates? So previously, this is nothing but, see, whatever auditor's responsibility we have seen, this is nothing but all that 5 points are collectively regarding risk assessment procedures only. So that they say it once again here. So identifying and assessing risk of material misstatement. So what they are trying to say here. In identifying and assessing the risk of material misstatement as required by SA 315, the auditor shall evaluate degree of estimation uncertainty with each accounting estimate. When you are trying to understand about the entity, environment and its internal control, when you are trying to identify and assess the risk of material misstatement, you have to determine for each accounting estimate what is the estimation uncertainty. Nothing but what auditor will do is he will make a list of all the accounting estimates. Whatever areas he found, whatever areas which require accounting estimate he has found as a part of risk assessment procedure, he will make a list like 1, 2, 3, 4, all the areas which require accounting estimate, he will make a list. Now against each accounting estimate, he will write estimation uncertainty. He will write estimation uncertainty. He will make one column. For example, first accounting estimate is there. Their estimation certainty is low. Second item is there, their estimation certainty is very high. Third item is there, there the estimation uncertainty is moderate, not so high, not so low. So like that, as an auditor, whatever you have understood as a part of risk assessment procedure, make a list of all the accounting estimates and determine what is the level of estimation uncertainty for each of that accounting estimate. And then after that, next one, the auditor shall determine whether in the auditor's judgment, any of the accounting estimate that have been identified as a high estimation uncertainty giving rise to significant risk. Now you have made this list to know. From this list, whatever areas you have identified which carry a high estimation uncertainty, you have to treat them as significant risk. Nothing but you have to pay more attention for that items wherever the estimation uncertainty is very high. So this is what outcome of the risk assessment procedure. Okay, by performing risk assessment procedures. Now, how you will perform this risk assessment procedure? That's what they have given in the previous step. How you will identify all that by using this, like sitting with the management, discussing with them, inquiring with them. So by doing all the above steps, you will try to achieve the outcome of that risk assessment procedures. Now, after performing risk assessment procedures, you will determine what is the estimations uncertainty in each of this risk you will identify. Depending on that risk, you will plan your further audit procedure. Like what further audit procedures you will perform? Based on assessed risk of material misstatement, the auditor determines whether management has appropriately applied the applicable financial reporting framework relevant to the accounting estimates. I have to check whatever requirements of applicable financial reporting framework are there regarding accounting estimates, whether all that has been complied with or not. Accounting has been done properly, disclosures are done properly as per Ind AS, that I will check. Next, whether the methods, just a minute, whether the methods for making accounting estimates are appropriate, have been applied consistently, and whatever methods they have followed for calculating accounting estimates, are they appropriate, and whether they have been applied consistently year after year, same methods are used or not, that I will check. If there are changes in the accounting estimates or in the method used for making those from prior period, those appropriate in the present circumstances. If they have made any changes in the calculations, I have to evaluate why they have made the changes, what are the reasons. And also, the auditor shall undertake one or more of the following, taking in account the nature of the accounting estimates. He has to perform the additional procedures also, like determine whether events occurring up to the date of auditor's report provide sufficient and appropriate audit evidence regarding accounting estimate. Take for example, what they are trying to say here is you are conducting audit for the financial year 2022-23. So balance sheet will be prepared on 31st of March 2023. Now, as on 31st of March 2023, management created a provision for expenses. For a certain expense, they have created a provision. As on 31st of March, they have created a provision for 10 lakh rupees. Now, after the balance sheet date, you will start doing the audit. Till the time you give the audit report, certain amount of time will be there. For example, you are doing the audit in the month of May. Your audit was completed. You are signing the audit report on 30th of June. You are signing the audit report. Now, till the time of audit report, you might have got some information determining whether this provision is correct or not. The management, while preparing the financial statements on 31st of March, on the basis of assumption, they created 10 lakh rupees as provision. But after the balance sheet date, you are doing audit for certain period of time? No. Now, during this time, after the balance sheet date, but before the date of auditor's report, did this event because of which provision was created, is it resolved? If yes, what is the actual outcome? So like this, you have to evaluate whether events occurring up to the date of auditor's report provide sufficient appropriate audit evidence regarding accounting estimate. Like for example, you came to know that this event because of which provision was created, that was resolved on 15th of June only. The actual expense turned out to be 10.2 lakh rupees. Yes, whatever estimate they have created as on the balance sheet date, that is correct only. Understood? Next one. Coming to the next one. Test check the data used by the management for making accounting estimate. On a sampling basis, you take a few accounting estimates and calculate it on your own. Test check it. Next one. Evaluate whether the method used for the management is appropriate. Once again, repeated point, you need to analyze whatever method that the management is using, is it appropriate, and it is as per applicable financial reporting framework. Testing the extent to which data on which accounting estimate is based is accurate, complete, and relevant. Whatever data the management is using for calculating accounting estimate, is it accurate, complete, and relevant? And consider source, relevance, and reliability of external data. From where they are getting that data for calculating accounting estimate? What is the source for that? Is that data reliable? Recalculating accounting estimates. If you are aware of that methods and all, you can also do the recalculation of the accounting estimate once again and compare it with the management's calculation. And test check the effectiveness of the controls over estimates used by the management. And also, in case if the client is having internal controls for calculating accounting estimates, check how far that internal controls are effective. And finally, the auditor should consider whether any specialized skills or knowledge is required in relation to aspects of accounting estimates to obtain sufficient and appropriate audit evidence. You should even determine for obtaining audit evidence regarding accounting estimate, do you need any services of the expert? Like in case if you are obtaining audit evidence regarding litigation, you might need the help of an expert like lawyer. So these are all the further audit procedures. This is how you have to respond to the risk of material misstatement relating to accounting estimates. So these are the audit procedures which you have to perform. What else is there? What else we have? Yes. What are the reporting and disclosure requirements regarding accounting estimates? This we can see it from the main thing only. So very simple thing. We are about to close the standard. Let us see what are auditors reporting and disclosure requirements. So disclosures relating to accounting estimates. What disclosures management is required to give? The auditor shall obtain sufficient and appropriate audit evidence about whether the disclosures in the financial statements which are related to accounting estimates are in accordance with the requirements of applicable financial reporting framework. Repeated point. They have told this in the objective also. Whatever disclosure requirements are there regarding accounting estimates, whether they are given properly as per applicable financial reporting framework or not, you have to check. And for accounting estimate that give rise to significant risk, the auditor shall also evaluate adequacy of the disclosure of their estimation uncertainty. In case if the management has created certain accounting estimate which involve high estimation uncertainty, they have to disclose even the fact that for this accounting estimate there is a high estimation uncertainty. That fact also they have to disclose. Able to understand? That's what they are telling. For accounting estimates that give rise to significant risk, the auditor shall also evaluate adequacy of the disclosure regarding estimation uncertainty. They have to even disclose the fact that this kind of accounting estimate carry high estimation uncertainty. That fact also they have to mention. Next, the presentation of financial statements in accordance with applicable financial reporting framework, including adequate disclosures of material matters. In addition to the accounting estimates, the management should have disclosed in their financial statements what assumptions they have used, what method they have used for estimation, what is the basis for selection of that estimation, any changes they have made in the method, and what are the sources from which you have got that data, all that. So this information is also required to be disclosed. By whom? Management. They are talking about management disclosure requirements regarding accounting estimates in the financial statements. Okay. Now, if at all, if the auditor found that if any of thing is missing, either they did not give the disclosure properly or they are giving incomplete disclosures, then the auditor, what he will do? He will give a modified opinion. Clear? Next one. In addition to that, SA 540 specifically says you are even required to obtain written representation from the management regarding their accounting estimates. That's what they say here. Written representation. The auditor shall obtain written representation from the management and where appropriate, those charged with governance, whether they believe that significant assumptions used in accounting estimates are reasonable. Ask the management to give a written confirmation regarding this. And even you have to document accounting estimates. Whatever things you have performed, whatever accounting estimates you have evaluated, what is the significant risk, how you have tackled it, everything should go to the audit documentation. So the audit documentation shall include the basis for the auditor's conclusion about the reasonableness of accounting estimates and their disclosure. So on what basis auditor has concluded, and also indicators of management bias and what bias you have identified, that also you have to document. So this is what completely SA 540 is about. So a lot of content is there, but I will mark a few content which is very important from the examination perspective. See, only once you read from the main material, I can tell you with confidence, you can refer to this summary notes. From this itself, you can prepare. From the summary notes itself, you can prepare. So that much comprehensive discussion has been given here. So now out of all this, what is going to be important in this standard? What is going to be important standard? So you can easily read from this summary material. So what is important? Objective. Objective is important. Objective is something which you have to read and learn. So this is something which you have to prepare for. Objective part you have to prepare. Definitions, not that important. What are the definitions which are important? Definitions are accounting estimate. This definition is important. Estimation uncertainty. This definition is important. And outcome of an estimation uncertainty. These three things are going to be important. So when it comes to nature of accounting estimates, here what you should do is, this is important. This you have to learn. This is also important. Nature of accounting estimates. This everything you have to remember. So which accounting estimates involve low estimation uncertainty, which involve high estimation uncertainty, what are the examples which are involving fair value, what are the examples which does not involve fair value. So this entire paragraph is very important. Nature of accounting estimates is very, very important. Management bias, not that important. Management bias, you can just read and ignore. Read and ignore. No need to by heart that. No need to memorize that. Read and ignore. Measurement objective, this is also same thing. Read and ignore. No need to memorize. Next one. Auditor's responsibility. This is very, very important. Auditor's responsibility is going to be important. This entire content you have to learn and memorize. And even audit procedures are also going to be important. This audit procedures are also going to be very, very important from the examination perspective. This you have to learn. This is not that much important. Written representation also not that much important. Documentation, once again, little bit important. This also you have to learn it. Okay. So the content is very huge, but I think I'm successful in making you to understand the standard in a correct perspective. This standard is one of the complicated standard because of the terminology getting used, because of a lot of ambiguity here. See, you will not be able to relate so many things practically, but I have put all the efforts to bring that practicality in you. I have taken you through the financial statements. I have read that disclosures given in the financial statements. So I thought of bringing a lot of practicality here. So I hope I'm successful in that. So with this SA 540 conceptual understanding, we are done with. So now what we will do is we'll take one short break. After the short break, we will do the Q&A part. After the short break, what we will do, we'll do the Q&A part. But before I give the break, give me one quick confirmation that you guys are all able to understand SA 540. I want one quick response, please, from your side. Just give me one quick response. SA 540, did you understand the concept in a correct perspective? I know the standard is a bit complicated, but I have put all my effort to make the standard as simple as I can. Come on, guys, give a quick response. Okay, guys, thank you for your responses. So now we will take a short break. After the break, we will solve the Q&A part of this SA 540. With that, we will end our today's session. Remaining discussion, we'll have it in our next session. So we'll be back after the break within 15 minutes. Okay, within 10 minutes, sorry, not 15 minutes. We'll take a short break of 10 minutes only. After that, we'll do the Q&A part. Okay, guys, welcome back after the break. So we have a few questions. We have a few descriptive questions talking about SA 540. So let us try to have a quick look at it. So we'll start with this question number 2. So these are the questions actually from the standards on audit chapter. So here we have something called question number 2. Let us see what is that question number 2. While auditing Z Limited, you observe certain material financial statement assertions have been based on estimations made by the management. As an auditor, how do you minimize the risk of material misstatement? Nothing but, first of all, you need to identify the risk of material misstatement regarding accounting estimates. Once you have identified the risk of material misstatement, what steps you can follow to minimize the risk of material misstatement? Like for example, if you remember the standard, so here what answer they have given is, so what things you can do in order to reduce the risk of material misstatement. So this is what they are trying to say here. So what things you can do, this auditor's responsibility they talk about, like we try to sit with the management, try to obtain an understanding of how the management identifies the need for accounting estimates. So I should understand how the management makes the accounting estimates. So this is what they particularly give the answer here. They're talking it from the management perspective. The same thing they say even in the question bank as well. So you observe certain material findings regarding accounting estimates. What things you will do to minimize the risk of material misstatement? See here, more appropriate answer could be, this is something where I don't personally agree. So when you identify the risk of material misstatement, more suitable answer would have been this. This you should have right. This you should have written. This is how you will respond to the risk of material misstatement. This will be the more suitable answer. But in the suggested answer, instead of giving this part as an answer, what they have given is this understanding. What things you will try to, what is your auditor's responsibility? Like you will understand how the management has made accounting estimates. Like you will inquire with the management and you will try to understand what controls were there, what methods they are using. This they have given it as an answer. This is what they have given in the suggested answer, which I personally don't agree at all. Why? Because once the risk of material misstatement has been identified, this is how the auditor should respond to the risk of material misstatement. This paragraph should have been the suitable answer. But as you know, I say suggested answer sometimes out of the context. So what they have given the answer is this paragraphs they have given as the answer. I don't personally agree with this answer, but still we can't do anything. We have to follow the suggested answer. If you don't follow the suggested answer, you will not get the marks. So this is what the test your knowledge question given from the study material itself. So let us see what they are telling. Nothing but whatever we have read in that standard, the same thing you will be able to find that part. As per SA 540, auditing accounting estimates, including fair value accounting estimates and related disclosure, the auditor shall obtain an understanding of the following in order to provide the reasonable basis for the identification and assessment of risk of material misstatement for accounting estimates. What you should do in order to identify the risk of material misstatement. The question they are asking is, how do you minimize the risk of material misstatement? But the answer which they are giving is, how can you identify the risk of material misstatement? So here itself it is out of context. Like what you will do, first you will try to understand the requirements of applicable financial reporting framework. Then you have to understand how the management identifies those events or transactions. Then you have to make the inquiries of the management, and even you have to understand what process is followed by the management, like what method they are using, what controls are there, whether they have used any expert, what assumptions they have made, and whether there is any change in the accounting estimate policy from compared with the last period, and all that things. Nothing but this is what I have told. So this one, if you remember the requirements of applicable financial reporting framework, how management identified, conducting the inquiries, and also trying to understand the methods, whatever they have used, like what method they have used, what controls they are having, what they have taken any expert assumptions. So this part they are giving. Once again, I am telling you, I personally don't agree with this answer, but this is what has been given in the suggested answer. Now coming to the next part, see, this is actually a one more concept regarding accounting estimate which we have to discuss. This question is very important from the examination perspective. Let us see what is the context of the question. This requires separate explanation, so I will explain it. But please have a look at the question, what they're asking. I will try to explain the answer in a detailed manner. A private company is engaged in the business of real estate. Okay. The auditor of the company requested the information from the management to review the outcome of accounting estimate, like estimated cost considered for percentage of completion, etc., included in the prior period financial statements and their subsequent re-estimation for the purpose of the current period. So you are conducting audit of some real estate company. Now, as an auditor, what you are asking the company is last year, not for the current year, in the prior year, in the last year, they would have calculated the accounting estimates, no? So in the current year, that actual outcome might have come last year when they whatever accounting estimates they have calculated, the actual reality might have come in the current year. So what auditor wants is he wants the management to share the last year's accounting estimate related data so that he can verify what is the outcome of that accounting estimate in the current year, and have they made any changes in the calculation of accounting estimate in the current year, that he wants to know. That's why he's asking the management to share the accounting estimates related data related to the prior years. What the management is doing, the management has refused the information to the auditor, saying that the review of prior period information should not be done by the auditor. Please advise. But what the management is telling, get lost. We will not give you the information for the prior year. You are appointed as current year auditor. We will give you only current year's data. We will not share with you the prior year's data. This is what the management is telling. Management has refused to share the information with the auditor. Is that acceptable? No, that is not acceptable. The answer is that is not acceptable. But what justification we have to write here? So if we further go into the applicable material of SA 540 and all, so SA 540 says also one more thing. SA 540 says, take for example, in the given case, you are conducting audit for the financial year 23-24. This is the current year audit which you are doing. Now, previous year will be financial year 22-23. Last year, as on the balance sheet date, client would have made accounting estimates. Now, since as on the last year's balance sheet date, since they don't know what is the exact figure in the last year, since they can't do precise calculation, what they have done is they have created a accounting estimate as on the balance sheet date. But that issue would have been resolved in the current year. That issue would have been resolved in the current year. That means outcome of the accounting estimate will be there in the current year. Outcome of accounting estimate will be there in the current year. For example, last year they have created a provision for expense of 1 crore rupee. Since as on the last year's balance sheet date, since they are unable to calculate, they made an accounting estimate. Now in the current year, that actual expense might have come. Now in the current year, you would have got that what will be the actual expense. So if the auditor gets to know what is the last year provision they have created and what is the outcome of that provision in the current year, he can get to know whatever methods that are used by the management in the last year's accounting estimate, are they appropriate? Is the management doing proper calculation of accounting estimates, or they are not making the proper calculation of accounting estimates? You will come to know if you could analyze this. But for this purpose, you need last year's data for accounting estimate. So, and also by checking the last year's calculation of accounting estimate, you will come to know what method has been used by the management in the last year for calculation of accounting estimates. Now I will check in the current year also same method is used, or any change in the method has happened. If any change in the method has happened, I will try to understand the reasons why the management has changed that method. And one more thing, by doing this verification, by doing the comparison of the last year's accounting estimate and its outcome in the current year, you can also come to know whether in the last year management has made any bias. That in the last year, management has made any bias in the selection of the accounting estimate. If yes, you can ask the management to eliminate that bias and do the proper calculation of the accounting estimate in the current year. So this much useful information you will get by verifying the accounting estimate data of the prior year and comparing that with the actual outcome of that accounting estimate taken place in the current year. And all this is permitted. Even SA 540 gives a permission for the auditor to verify the accounting estimates of the prior years with the actual outcome of that accounting estimate in the current year. Why? Because you are going to get this much relevant information regarding accounting estimates of the current year. That's why SA 540 has given the permission for the auditor to get all this information. But in this case, as they have told, management is telling they will not respond, they will not give that last year's information. They are telling no, you do only current year's audit, we will not give you last year's accounting estimate data. They are telling, do you think it is acceptable? No, it is not going to be acceptable. The management has to share even this information with the auditor so that he can form all these conclusions regarding accounting estimates of the current year. Clear? The same thing even they try to mention in the answer. So if we go through the answer, as per SA 540, auditing accounting estimates, including fair value accounting estimates and related disclosure, the auditor shall review outcome of accounting estimates included in the prior period financial statements, or where applicable, their subsequent re-estimation for the purpose of the current period. So even SA 540 is asking the auditor to verify what is the outcome of the last year's accounting estimate. As an auditor, you need to check last year whatever accounting estimates management has created, what is their outcome in the current year. And also some provisions, some estimates require re-estimation in case last year management created a provision. Okay, for example, depreciation. Depreciation last year in the financial year 22-23, management has purchased an asset. For charging depreciation, they made a useful life of 5 years. They made a useful life of 5 years. But in the current year, you came to know that actually the useful life was wrong. This plant and machinery can be used for a period of 10 years. By mistake, management has made a wrong useful life. As on the date, whatever information is available with them. Last year, whatever information is available with them, on the basis of that information, they estimated useful life to be 5 years. But now they got to know the correct information, and now they have determined that no, useful life is not 5 years. Useful life is 10 years. Now what they should do in the current year, when they calculate the depreciation, they have to change their accounting estimate to 10 years, recalculate the accounting estimate, and going forward they have to recognize that recalculated accounting estimate. So that's what they're telling here. As an auditor, you have to check the outcome of the accounting estimate of the previous years, and in case in some circumstances, if required, you might be required to re-estimate that accounting estimates in the current year because of the availability of new information. Next one. The nature and extent of auditor's review takes account of nature of the accounting estimates and whether information obtained from the review would be relevant in identifying and assessing the risk of material misstatement made in the current year. Nothing but if you review the accounting estimates of the previous year, that will help you to identify and assess the risk of material misstatement of the current year's risk. If you verify the last year's accounting estimates and their outcomes, that will help you to identify the risk of material misstatement relating to the accounting estimates of current year. That we already know it. Nothing but you can use the prior year's information for evaluating in the current year's risk of material misstatement. Next one. The outcome of accounting estimate will often differ from accounting estimate recognized in the previous year. Obviously, last year, whatever accounting estimate you have created, whatever is the outcome of the accounting estimate, there will always be difference. That is not a misstatement actually. Since we don't know in the last year as per the information available, that's why we have created a provision. It is always common, whatever actual outcome we get, that could be different from accounting estimate. It is quite common. By performing risk assessment procedures to identify and understand the reasons for such differences. Then when you find differences between the last year's accounting estimate and the current year's outcome, you need to analyze, is there a high estimation uncertainty, is there a low estimation uncertainty? Like take for example, last year the provision created was 1 crore. Since they don't have proper information, they created provision only for 1 crore, but actual expense turned out to be 2 crore rupees. That means there is a huge amount of there is a huge difference between accounting estimate and actual outcome. So might be last year management did not calculate the estimate properly. That means in the current year also there is a high risk of material misstatement. I should ask the management to properly calculate the accounting estimate this year, because when compared with the last year, when compared the last year's actual outcome with the last year's accounting estimate, the difference was very huge. Now we'll ask the management, sir, last year you might have done something wrong in the calculation of that accounting estimate. In the current year, please try to make a proper calculation so that there will not be a huge gap. So by performing risk assessment procedures to identify and understand the reasons for such differences, the auditor may obtain information regarding the effectiveness of management's prior period estimation process, from which the auditor can judge likely effectiveness of management current process. So by understanding the last year's accounting estimates and their outcome, you will come to know how far last year's accounting is, how far the process followed by the management in the last year is effective, and if required, is there any requirement is there any requirement to make some changes to the process in the current year. Next one, audit evidence that is pertinent to re-estimation in the current period of the prior period accounting estimates. If at all, if you study the last year's accounting estimates, you will also get audit evidence. Is it required to make a re-estimation of that accounting estimate in the current period? And also audit evidence of matters such as estimation uncertainty that may be required to be disclosed in the financial statements. And even you will get to know about the matters. If you study the last year's accounting estimates, you will also get to know, is there any extra disclosures regarding uncertainty required to be given in the current year? And the review of prior period accounting estimates may also assist the auditor in the current period in identifying circumstances or conditions that increases the susceptibility of accounting estimates or indicate the presence of bias. If you study the last year's accounting estimates, you will also get to know whether management has shown any bias while calculating the last year's accounting estimates. And the auditor's professional skepticism assist in identifying such circumstances and in the nature of extent of further audit procedures. Nothing but how you can identify all these things is whether bias is there in the last year or not, that you can find out if you maintain an attitude of professional skepticism. If you maintain questioning mind, if you don't accept anything blindly, then only you can get to know whether there is a bias or not. However, the review is not intended to call into question the judgments made in the prior period that were based on information available at the time. See, when I am checking the last year's accounting estimates, my objective is not to find out whether last year's estimates are correct or not. Because when last year estimates are calculated, those will be calculated depending on the information available at that point of time. Just why I am checking the last year's accounting estimates is there any additional information available in order to change my accounting estimate in the current year, or in the last year, depending on the information available, did they follow any wrong method which requires changes in the current year? So when I am verifying last year's accounting estimates, my main objective is not to find out mistakes in the last year's accounting estimate. Why? Because last year's accounting estimate was calculated on the basis of information available as on the last year. Just I am checking, did the management need to change some processes in order to make the accounting estimates more relevant in the current year? That is what my objective is. In the given case, the management is not correct in refusing the relevant information to the auditor. So in the given case, the management is telling, we will not share with you the last year's accounting estimates related data, which is actually wrong. They have to share it with the auditor. Understood, everybody? So this is what simply regarding this answer, very important from the examination perspective. This question is very important. Please do mark it. Please, you have to go through this particular question before going for the examination. So what is the simple summary, guys? So yes, last year's, as per SA 540, you should review what is the outcome of the last year's accounting estimates, and by doing that you can identify the risk of material misstatement relating to accounting estimates in the current year. And by understanding the last year's accounting estimates, you will get to know whether process followed by the management in the last year, is it effective, or is there any requirement to change the process in the current year. And by verifying last year's accounting estimates, you will also get to know, is there any re-estimation required in the current year. By verifying last year's accounting estimates, you will also get to know, is there any additional disclosures required to be given regarding estimation uncertainty in the current year. And also, by verifying last year's accounting estimates, you will also come to know, is there any bias in the bias of the management for selecting accounting estimates in the previous year, that you can get to know about it only by maintaining an attitude of professional skepticism. And that's why management is not correct in refusing the auditor to share the information. They have to share it. Clear? So these two are the questions relating to SA 540. Hope you guys are able to understand. Clear? So with this, we are going to end this session. So today we are done with SA 540. Tomorrow we'll try to complete SA 560. So this is what regarding SA 540 related discussion and the questions. Hope you guys have understood it. Hope you guys have got the practical understanding regarding this concept. Clear, everybody? Right.